Okay, go ahead.
So, good afternoon, everyone. I think we have had four fantastic presentations. I just hope that I'm able to catch up with them or be at par with them. Just a standard disclaimer, I am not SEBI registered, not authorized to recommend anything, and the presentation is only for learning and educative purpose. And I hold the stock in my portfolio as well, so I'm heavily biased towards it. So the company we'll be discussing today is V2Retail, which is into value retail segment. And so retail is one of the toughest businesses for retailers, for managements, for analysts, and for everyone to decipher because it is one business which always throws a curveball at you and you're not able to understand where did the projections go wrong. And this has happened time and memorial. People have made huge lot of money with retail, but a lot of people have lost a lot of money with retail because you never know where it goes wrong. And uh, broadly breaking down retail, it is broken down into different segments. We have the luxury segment, we have the premiumization segment, which is borderline luxury. Then there is masstige segment, and then there is value segment. Now, why value segment? As Indians, we are always seeking value in whatever we buy. And this is one segment which has relatively outperformed the Indian market in the last 2 to 3 years. And we'll discuss later how everybody in the industry is now running towards this segment and trying to tap this segment. And why V2 retail? Because it fit into two or three matrices with which I wanted to evaluate value retail, and V2 was the front runner. Uh, so if you see the usual course of the business, V2 has been a pretty old company, and it is a company which has had a sort of turnaround in its journey. It was started in 2001 by Mr. Ramchandra Agarwal, who was a first time entrepreneur. And he started the company, and the company became listed by the name of Vishal. We know there is another company by the name of Vishal Megamart. That's a different company. But he started the company in 2007, and ultimately, what happened is they did very rapid expansion and the company went bust. And he had to ultimately sell off the Vishal brand to Vishal Megamart. And then V2 Retail was reincarnated later and was reborn. And today it's known by the name of V2 Retail, which sells apparel products mostly in tier 2, tier 3, tier 4 towns, which is affordable. And their value proposition is they offer value and variety to the consumer, and they want to cater the new middle class or the middle class which is thriving in these cities, which has more disposable income, as we have been seeing that the consumption is tier 2, tier 3, tier 4 is exceeding what is happening in the urban cities. So this is, if you look at the right, this is the kind of revenue mix V2 Retail has. So we'll discuss two or three companies more in this segment, but V2 is possibly the only one which is more into pure play apparel. So they have roughly 90% or 92% of their business coming from apparel. If you see the general merchandise or the lifestyle, which is the other part of the business wherein you sell sunglasses, etc., has dropped for them. So they are mainly into apparel. If you see the revenue journey, 2021, 2022 were COVID years. And from 2023, if you see, this is the kind of growth the company has shown from 839 crores of revenue in FY23 to 1884 sort of top line in FY25 and FY26, though the official results have not been released, they would be closing in somewhere around 3,000 crores of top line. Again, more than 50% growth. The EBITDA margins have expanded sharply. The retail space which they have, that is the total size retail carpet area or the retail area which they have, has grown up to 20 lakh square feet. And this is the kind of PAT they are doing. A loss-making company in 2021, 22, 23, and they are now profitable. They are running, and they are hugely PAT positive now. Their sales per square feet, which we will evaluate with other players in retail also, particularly in value retail, is amongst the top benchmark in the industry. And the rentals per square feet are close to 50 rupees, which is very important for value retail. So I would say that in 2021, if I correctly remember, we know by the name of Trent, a company. Zudio was one concept which became the blue-eyed boy of the street. And Zudio gave the sort of throttle to Trent, which nobody expected. After Zudio, which is again a little premium to V2, the other blue-eyed boy is V2 Retail now, which has consistently outperformed for the next for the previous 2 3 years, and we'll see that what are the antithesis or the risk also to this business which can develop in the future. So these are the operational highlights. So I have structured this slide in a way that I wanted to make it a little exciting for you. So EPS is what everybody wants in the market, earnings per share, and price to earnings multiple is what everybody looks at. So I'm just seeing that can EPS turn to price exuberance for V2 retail? So if you see the nine month benchmark for V2 retail volume growth is fairly well. Average selling price is 329, which is normally the case, which is in this segment. The net working capital days has reduced significantly to 37 days in FY25, FY26 or FY25 to be precise. And why this is important is that gives company less requirement of working capital and their return ratios can be better. This is the full price sales, which is again very important because this industry operates at very thin gross margins, around 30 to 32% gross margins are there. So if you do heavy discounting, you lose a lot of money over here. Sales per square feet, they were doing close to 1,050 sales per square feet over the last year, but now this year it has dropped to 980, and I'll also explain the reasons why it has dropped. And same store sales growth is 8.6%, which was close to 20 to 30% last year. I will again explain why it has dropped this year. So what is standing out for V2 retail? First is the EPS part, excellent operations. So if you look at them, their SSGs, which is the same store sales growth, and the PSF is amongst the best in the industry. Their ASPs are not showing a heavy increase, and there might be a reason that they are getting new customers who are first time shoppers with them. So they're not buying a lot, but they might turn into regular customers later on. The new store metrics are really good. They are operating at 70 to 80% of operational efficiency for matured stores, and the store economics are remaining intact for quite some time. So the E part is doing fairly well right now. Then comes the P part. Their product is selling well. Full price sell through is good enough, right? They have focused more towards private label, which again improves their gross margins. Revenue mix is more towards apparel side, which is easier to sell, easier to display, easier, and it takes lesser space in the stores. Supply chain has reduced a lot, has improved a lot, and logistics, they are trying to improve it so that they have more drops inside the stores and the frequency improves more so that more efficiency can be brought into the stores, more space can be utilized. This is the product excellence, and S is the standout expansion. In retail, one thing which matters the most is location, location, location. Because the kind of capex you do in retail, if you open at a wrong place, there is no looking back. Either you
Karena
have
lagi
to.
anak pucuk ni, kung lagi mo ulo ral kanya kan.
Puneet, I'm getting some disturbance. Yeah, sorry. So, as I said, location, location, location is really important in retail. If you open a store, there is no looking back for the next 2 to 3 years. Either you work towards getting your payback or you're done with. You have to close the store and ultimately take heavy losses on your books. And the closure cost is roughly 300 rupees per square feet. So that's a heavy cost. And then there is a capex cost which goes. So it can be really detrimental for any retail company. So they haven't seen a lot of closures as of now. 2 years of heavy expansion has happened, and we would see in the current in the next year how these expansions are shaping up for the company. But so far, so good. And they are very aggressive in their expansion. They are still maintaining they would open 130, 140 stores every year. So the prospects look good as of now as we proceed further. So this is the industry landscape, how the industry is looking. Tier 2, Tier 3 markets are growing with more disposable income. We are also hearing about blue collar jobs earning more. So the primary customer for V2 kind of companies is somebody who would have a disposable income or an annual or a monthly income of 20,000 to 50,000, 60,000 rupees per month. Youth is more oriented towards fast fashion and value for money. Value retail has consistently outperformed an unorganized to organized shift, which we have consistently heard from everyone that people are moving to more towards organized retail and buying from there because that gives them some sort of brands also and fast fashion at a very good pace also to people. Opportunities, top line growth has been much better than peers. Expansion is faster. Right now, no major slowdown is there in terms of expansion or no growth is there in terms of store closures. Earnings is the indicator that they are able to do profitable business. The PAT growth has been really healthy. And the biggest thing for them has been that they have been able to raise money from marquee funds also through QIP in November. And most of it was towards expansion and repaying certain debt so that to make their balance sheet even leaner. Uh, what are the challenges? Expansion into new geographies, because once they are concentrated in a particular geography, expansion into a new geography can become really difficult. Operations are very people dependent in companies, not so much in value retail because it's the product that matters, but a lot of attrition can lead to difficult operations in certain newer stores, and that could hamper the store metrics. Competition, everybody is raising funds, and we will see in the later slides, and NSO performance can become a challenge. So just to give you context, over the last 2 years, V2Retail, in 2 financial years, they have opened close to 180 stores. They were close to 120, 130 stores in FY24, and as of FY26 closure, they are sitting at close to 325 stores, if I'm not wrong. So that's massive expansion. And if the stores don't click, ultimately you have to take the harsh calls. Inventory gets blocked. Your assets get depreciated fairly quickly. You're not able to sell your assets. And there are a lot of problems which crop up. And they have gone bust once before also. This is the company performance over the past few years. And this is, if you see the EBITDA margins, they have expanded from 9% to 13%. And the depreciation cost and other costs come below because we have moved to lease accounting now. So the PAT has been really healthy. They have reached a PAT of close to 4% now. And in my assumption, they should close this year at somewhere around PAT margins of 5.5 to 5.6%, which could be the peak as of now for them, which we'll discuss. So this is how the economics look like for 9 months. I would have been happy if it was for the full year, but this is how it looks. The PAT margins as of now stand at 6.3%. Q4 would not be as blockbuster as Q3, so it should certainly drop down for the annual basis. But yes, still a very healthy PAT growth for them, a very healthy. So if you see, the PAT has almost doubled, and in this quarter, in Q3 quarter, the PAT has almost doubled, and it's a fairly healthy growth for them. So, few of the achievements, they have hit their highest ever annual revenue of 3,000 crores, continuous improvement in PAT margins, good store economics with rents hovering around 50 rupees. So, a good thing about these geographies is that you get really good rentals. So, rental is a big part in retail. And if you're able to crack that, your economics improve drastically. And it looks like they would have a 1,200 crore quarter also in FY27, one quarter, which could be Q3 quarter. And that is something we should look out for. Gross margins have sustained, very minimal store closure, best PSFs even after expansion. We will see the PSFs of other retailers, and we will see how they have done better over there. PAT margins could have reached the peak, and that is something which we have to look at. So our assumptions have to be based on that a PAT margin of 6% annualized is a difficult proposition to handle. This is the balance sheet, nothing more, nothing much to see. So this is as of H1. So the QIP amount would not be reflecting over here. So they have raised a QIP of 400, wherein funds like Malabar have also entered, and Motilal Oswal has always been invested in this company. And capex per store is close to 1,000 rupees square feet. So just to give you context, in premium retail or with retailers like Aditya Birla, the capex is like 4,000 to 5,000 rupees per square feet, the prime stores, and it's somewhere around 3,000 rupees per square feet in tier 2, tier 3. So this is where they save a lot of cost. And these are some of the warnings. Store closures could lead to heavy write-offs, has a history of going bust. Competition could eat their market. There could be a lot of cannibalization going forth. And balance sheet as of now is good enough for them to ride the turbulent times. There is a growth in inventories, but they're opening a lot of stores. So you have to build the inventory. You have to pre-build the inventory to serve those stores. So I've deliberately not put the names over here because I wanted everybody to guess and make something out of this data. These are two different competition, and this is Star Bazaar or Bazaar style retail, which we know it operates out of the east. And see how this industry is growing, because competition was important to put in over here. And if you see, everybody over here does not have the metrics which V2 has right now. If you see, the sales per square feet is 743 bucks, and inventory days are fairly the same. And if you look at over here, V2 has relatively bigger stores than Star Bazaar, but there is not a lot of difference between them. And this is VMart. So VMart operates in a lot of other markets as well, they have the highest stores amongst them, and they are earning a PAT margin of close to 4%. As I said, that V2 has reached a PAT margin of 6%, which might not be sustainable. This is the kind of market which is there. Everybody is growing and everybody is gunning for the same market. This is important. As I said, that V2 operates in tier 2, tier 3, tier 4 cities because that's where their customer lies, or it's easier for them to crack those markets. The competition is not Zudio, but Zudio could be the benchmark. This is Zudio data. So as I was speaking about that, since 2022, this is how Zudio has moved, and this has really helped Trent outperform the markets, and their growth has been important for Trent. Similar trend could play out in the value retail segment also. So if you see the tier wise data, tier 1 for VMart for 9 months has degrown if you look at the relative data in terms of sales per square feet, etc. But other markets like tier 2, tier 3, tier 4, even on a bigger base, has grown for them. And if you look at the absolute numbers also, 14%, 12%, 27%, 7%. So they have relatively grown more in tier 3, tier 4, which revalidates the view that there is a lot of opportunity in these markets as well. Now, this is the store count. This is V2Retail, where they are operating right now. This is Star Bazaar, where they are operating right now. And this is VMart. What can be deciphered from this data is two things. One is that competition is entering the territory where you are stronger. If you look at V2Retail, which are their growing markets? It's West Bengal. There are markets like they are moving to South also, where they are developing their footprint. Where is Star Bazaar moving? If you look at their non-core markets, they are Uttar Pradesh, where V2Retail is doing well, right? So everybody is trying to enter into each other's markets. And this is where the challenge becomes for every retailer, because you're entering into a new geography. You have to crack the market at different levels, right hiring, right product, because the product language changes from region to region. So it's very difficult for you to enter a market and crack it easily when a competition or an incumbent competition is already sitting. The third metric tells us about this is VMart. So VMart is relatively present in South as well, and this is one of the untapped markets. And why VMart is also present over there is because they acquired a business from Arvind, and so they took over the stores over there. So this can be one of the opportunity markets also. The basic crux is that this is such a big market. V2 has only 50 stores in Uttar Pradesh, but VMart is sitting at 170 stores. So imagine the opportunity, imagine the number of towns which these guys can leverage if done well. So it's not like that V2 has opened 300 stores, 350 stores. They cannot open another 100, 150 stores in a year. It's very much possible they can continue with the same run rate, but again, capital efficiency becomes really important, because you can open the stores, but the closure can lead to a mountain which you can never overcome then. So just wanted to highlight over here how the industry is moving. See, this is the snippet from ABLBL con call or ABFRL con call. If you see, Style Up is their business in value retail, which they have renamed now to Own. They're looking at opening stores. We look to add 40 stores, and this concept does not work for them. So a brand like Aditya Birla is also moving into this space which has got heavy pockets. This is Bazaar Style, another guy in the east sitting there. They have got funds from a marquee investor from Cupid. If you know the company by the name of Cupid, they are investing into Bazaar Style. They have also raised a QIP, and they are also looking to scale up. This is a snippet from Zudio or Trent slide, where they are saying tier 1, tier 2 cities, as we accelerate, there is heavy amount of acceleration open there, and over 80% of the stores were opened in tier 2, tier 3 and new geographies. So these geographies are working well. And again, if you see that they have proposed raising additional 2,500 crores for expansion. So the market is really big, and the big sharks are also playing very aggressively in this market. So something which we have to see. And as I was saying, this was the QIP which V2 raised. There was a lot of interest. Few funds which we should track, and I personally track, is that Malabar entered this during the QIP. They have also put in money, and Sukham Ventures has also put in money over there. And Motilal is an old investor, so nothing much to read over there. So if you see over here, I have just broken down some positives, some game changers, some drawbacks for V2 Retail, which could come from internal and external headwinds. Internal tailwinds or headwinds and external tailwinds or headwinds. So there is excellent top line growth over the past 2-3 years. Good profitability has been there. What can be the game changer? Fast growth sustaining. No major store closures. Newer markets working well for them. They go to West Bengal, they open 60 stores, everything works. They are able to do better than bazaar style over there, nothing like that. The biggest drawback can be operations not sustaining for them, which is a big possibility and which could lead to more store closures and bad inventory planning. You have empty stores, you're not able to plan your inventory well, which could lead to initial customer response being very bad in new geographies, and you could lose the game over there. External, their strength has been their execution has been better than peers. Demand is picking up, so there is no slowdown in demand. In fact, I was reading a few of the retailers' updates in Q4 of this year, and even the laggards have done better in Q4. So that means the GST impact or whatever impact, if you tell the people the income tax rebate or whatever be it, has helped pick up the consumption, which we are seeing as a trend. So no slowdown seems as of now. Unorganized to organized shift is a big game changer. Competition not sustaining. We have seen V2 has failed in the past. There is no reason other competition which is raising funds also can fail, right? So it's all about execution in retail. Drawbacks can be externally, they enter into markets where consumption is not that strong for organized retail, and they have to do heavy discounting to sustain the trend, which impacts the gross margins and ultimately impacts the P&L. And bigger players like Aditya Birla and Trent, Zudio, and Tata is burning money to gain market share. Ultimately, they have deeper pockets than V2 Retail, and you cannot do anything over there. So one slide to see the industry structure, what is the current run rate, V2 operations and V2 strategy over there. So this is the industry structure. Industry is thriving. V2 has been the clear trend setter. Huge untapped markets, demographics, smaller towns have more disposable income, which we discussed. Other retailers are also doing rapid expansion, which is a big risk. Slowdown in economy and lesser demand could lead to a huge drawdown for the company as well. Other retailers could get into heavy discounting. Rental yields, as of now, the rental yields in smaller towns are in control, but as competition crops up, it could become competitive. The rentals might spike up, and it could ultimately impact your P&L. This is how V2 operations look like. Their top line is backed by healthy profitability. EPS growth is intact. The expansion is working so far so well. Store metrics are intact. The drawback is what I feel, that they are very promoter heavy business. They don't have a CEO. Right now they have 320 stores, and they would probably exit this year with 450 stores. If they don't get a CEO, it would be very difficult to manage the operations and manage the back end and manage the company at an overall level, because we have to understand this industry needs a tab on every aspect of the business, whether it is supply chain, whether it is business development, whether it is capex, whether it is new store opening, whether it is operations, and whether it is marketing. So you need more hands into the business. The management is very aggressive. They have gone bust before. There is no reason they cannot go again. Current run rate, V2 strategy. Currently, they have only COCO model. So there are different models in retail, but they have COCO model, and it is a good to go strategy because their rental, because the capex is not very huge, and it helps them to manage the operations in a better way. Cash on books should be sufficient, that there is no further equity dilution in the next 2 years at least, and that is where we should look at this company from a horizon point of view. Leadership has to be developed. They must develop a better leadership team. That should be the strategy. And they should focus on their supply chains as well, because ultimately getting a hang of it or faster drops would help them maintain their ROCEs and all that. New store failures, 3x store base, as we discussed, could be a big risk for them. Competition could again be a big risk, but I have put in a certain cheat codes which we should have. I think they should hit a 1,200 crore quarter this year. If they don't hit that, then, or they miss it by a huge mark, it should be a big red mark for us. It should possibly in Q3, which is the best season for them. And a 1,500 crore quarter should be there in FY28, which should be on radar. So FY27 and FY28, we should closely look at these metrics. Their SSPDs would roughly fall into the range of 930 to 940 because of newer stores also opening up. Some cannibalization also happens when new stores are opened up. The older stores lose some amount of business because consumers get bifurcated, but it should never fall below 850 because that's a serious problem. And SSGs would again fall during the initial expansion phase, but it should come back. So anything less than 5%, serious questions have to be asked why the SSGs are falling to less than 5%, or if they fall negative, then serious questions have to be asked whether expansion has to be paused for some time, stores have to be sustained, because every impact on the top line really breaks the P&L downwards, and it's very difficult to maintain the profitability in retail business, because your rentals, your employee costs, everything rises, and it's very difficult to maintain the profitability at a store level, and you never know when it spirals down and you have no control. So this is the most difficult business to build assumptions into. So I just tried doing something over it. This is the chart above has the historical metrics on how V2's price to earnings multiple has behaved over the past 2-3 years. It has never fallen below the 50 level. I hope it doesn't fall. It has maintained that, and it has outperformed the market also. This is how it looks. The chart on the lower side actually represents the most bearish case which could happen, where V2 makes its investors cry. This is actually the chart of Trent. How is it? It has shaped out from here. So earnings growth slows down, your metrics slow down. So I had taken a basic assumption that if all goes well, if their expansion goes well, and this is the kind of some simulation I had done on what is the kind of SSPDs they could, or sorry, PSFs they could be having. So they could be exiting the business and at around 3,000 crores in FY26, which they are closing. I've taken PAT margins at 5.6. It would be higher also. An exit multiple of this should be sort of market cap. And if all goes well, PAT margins, even if they drop to 5.5%, which could be the industry benchmark, they could be sitting here at a valuation somewhere around more than 20,000 crores by FY29, subject to conditions that other conditions are also met. Then barely smiles, competition comes alive and kicking, multiples drop, the industry consolidates, everybody is eating everybody's pie. The PAT margins drop to the benchmark of 4.5, 4.6%. Still, the case says that, okay, they could still be at 11,000, 12,000 crores of market cap down the line. Their store closures are heavy. They are not opening a lot of stores, and the SSPDs drop drastically. And the last case is PAT margins just revert abysmally on the downward side. You don't have a track every quarter. PAT margins estimates are getting beaten down. Gross margins are getting impacted. SSPDs are falling, or PSFs are falling. And this could be something which we should watch out for. So this is how the business looks like. This is the actual chart of V2. The previous one was for Trent, and the stock is getting consolidated over here. Marquee investors have entered at around 2,100 rupees, if I'm not wrong, pre-split. So the stock got split. So around 210 rupees a share in funds like Malabar have entered. Profit growth could sustain momentum. No more funds could be required. Execution on track for multiple years. Stock is near the QIP price. Product acceptance look good, and many geographies are intact. The biggest risk I see is the management right now. They are expanding very aggressively. There is no tangible answer why they are not able to attract talent and have somebody at the top as a CEO or something. If you look at in the past also, they had a CEO, but it was mostly run by the promoter only. So it could be a one-man team leading the charge, and it could get really difficult. The good part is they have executed quite well over the last 2 years. The metrics have not dropped, and they are fairly confident that they would continue with the same pace. And looking at how the competition is also seeing the space, how the biggest players are also seeing the space, it could be like that everybody gets a pie of the business. So this is what I feel about V2 Retail as a business as of now. I'm biased in this, but I think we should keep a very close eye on the metrics, on the revenues, on the PSFs for some time, and just see that not from benchmarking against the competition only. It shouldn't be that it outperforms the competition, but we should also see how the industry is shaping up. Because once your profitability starts getting impacted, it's very difficult to recover the business. So that's it from my end. Yeah, thank you.
Yeah. Thanks so much. So 2, 3 questions basically. One, is it seasonal business? Like Q3 is the best one, as you said, right? So, but over the period, if you see, it's oscillating basically from the March, September, and then
So there is seasonality, Puneet. Every time in retail, there is seasonality. So there are companies which are very wedding dominated. So if you look at companies which sell a lot of suits and blazers, they do very well in Q3 and Q4, wedding oriented businesses. V2 for V2, Q3 is the biggest business because there is winter wear over there. So winter wear has higher ASPs. So some seasonality is there, but you should always see this business from a point of view that every YOY growth, how is it shaping up for the business? So their YOY growth cannot drop down. There cannot be a slowdown in that. So for V2, Q3 will always be the biggest business. In fact, for a lot of retail companies, Q3 is always the biggest business. That amount of cyclicity is there for them. And then the months where wedding and festivals are there, those months are very heavy. So if you look at bazaar style, why it is not getting priced properly in the market or why it is not getting recognized is that it performs during Pujo festival because it's based out of West Bengal. So for them, if Pujo falls in Q2, it's a great quarter for them. If it falls in Q3, the market knows, okay, Q2 would not be good enough, Q3 would be good enough, and then that falls flat. So some amount of seasonality will go in as they move to different regions. For example, if they move south, then festivals like Ugadi, Pongal, all these are there. So that takes away some leeway from there. In north, they have Eid and Holi, which comes in March, April. So some seasonality would go away, but Q3 would remain the biggest quarter for them.
Okay. Another question is, see, they are expanding stores faster, and I see their lease liabilities have been going up because of this model of COCO, right?
Yeah.
So we have seen this model failing out previously with the bigger names also in the past. Do you see that kind of a risk attached here?
That's the biggest risk. See, if their SSPDs fall a lot, so I'm in habit of saying SSPDs. So if their PSFs fall a lot, right? So you would always have to see that right now, if they're doing 1,000 rupees of PSF, their rent is around 50 rupees. So 5% rent is going on, right? From their pocket. If this rent goes to 7 to 8%, then there is serious trouble with the business. That means they are expanding, they are paying higher rents, and then it becomes a big problem for them. So that should always be on track. What is the kind of rentals they are paying and what is the kind of PSFs they are maintaining? It's a big risk. But in hindsight, why they are doing this is why they are moving to the COCO model is because they have 30% kind of gross margins, right? Any franchisee would look at 15-16% of margins. That leaves very thin margins for them also, right? And then the other thing is a lot of problem comes with store operations when you have franchisees, and if you have a lot of stores, you need to have more people in your team also to manage with the franchisee, etc. I think they might move to a FOCO model down the line, which is franchisee owned and company operated, but not sure that they are looking at right now because they have the QIP amount right now. So maybe after 500, 600 stores, when they do a new QIP, a new model might come in, but it's early to say that.
Okay. And one question, last question from the chat is Q4 from the company. Do you think it is impacted by the geopolitical situation or no? I think it's mostly domestic business.
No. So one of the theses also why I was looking aggressively at this business was also because it's a very domestic oriented business and it's very tier 2, tier 3, tier 4 based sort of a business. I don't think so that should be any reason. And in fact, a lot of companies in Q4, as I said, the laggards like even Page Industries after Q4 in this Q4 has given superb results if you look at the past quarters. So a lot of companies have come out with very good results. Maybe some raw material pricing issue, something might happen, gross margins might drop 100 basis points, 200 basis points. But I think in terms of their execution, we shouldn't see any slowdown. In fact, the Q3, Q4 numbers are already released. The top line is close to 800 crores. I don't think so. They should be gunning for less than 40-50% top line growth in any quarter going forward. The kind of expansion they have done.
Okay. Yeah, I think that covers all the questions we have till now.
Yeah.
Okay. Thanks a lot for your presentation and time.
Thank you. Thank you.
Yeah, we can stop sharing. Then we can move to the next presenter, Vardhan. Vardhan, you can hear me?
Yes. Is my voice clear?
Yeah, we can hear you.
Okay. Let me try to share my screen. Are you able to see the presentation?
Yeah, we can see it.
Right?
Yes.
Shall I start?
Go ahead. Yes. Go ahead.
So, good afternoon. Thanks for the invitation. So, it's my first time presenting. So, please bear with me a little bit and cut some slack. So, I'll try my best to answer the questions. And so I'll start with what the company is. So, this is Medicure, which is a medical device company. Its main business is in making inpatient consumables, mostly inpatient consumables, essentially, infusion pumps, various types of syringes, and this I'll show you the business this in a little bit. This is their main business. Now they are branching out into a couple of high tech. In comparison to what they are now branching out into, the current business or the past business is in the area of consumables, which is a little less technical or technology oriented, more related to commodity oriented. Now they are pivoting into a new, so that is perhaps our trigger. The entire presentation, I will try my best to not be biased. So it will be a little bit of difference from the others who present, who are generally very passionate about what they present, because I am making an attempt here to not be, aggressive about this. So please do criticize. This is just my view. My name is Varadan. I am a faculty in biomedical engineering. I teach courses on biomedical engineering. This is my core field, medical devices. This is my core field. I have a failed startup in the field in this field in medical devices. So I know what are the problems with the industry, what are the challenges, what is the mode of an established company like Medicure, and what are the challenges for the same company to enter into new business. So these are all things that I know not from a theoretical viewpoint as a faculty member who knows this stuff, but also from a practical business viewpoint as someone who has failed attempting to succeed in these things. So it's not about technology, just there are many things, and I'll discuss that from that perspective. So to the extent possible. So that way it will be a unique perspective for you. It's not just the business analysis, something that comes only from having experience of having failed in this. So Medicure is essentially, if you go through screener, you'll understand that it's essentially a debt-free business. All the things will appear clean in most of the primary things that you look at will appear clean on Medicure. Essentially, it makes in terms of business, it makes number three. It is number three in terms of making IV catheters. So intravenous catheters. It turns out is a very specialized product that are made out of relatively inexpensive material, but requires sort of expertise in manufacturing and also expertise in minimizing waste when it comes to this. Right now they are moving into a technology strong regime with about 400 patents, about 392 or 390 plus patents, and is strongly promoter owned, 62% promoter owned. Mr. Baid, who is the MD of the company, has been a long time leader of the company. The stock was at 2,937 rupees some time ago, about 2 years ago or so, and recently in April, when I and discussed, it was about 1,180 or 1,190, and from there till yesterday, it closed at about day before yesterday, it closed at about 1,598 or 1,600 approximately, and tomorrow is the results, right? And that's key. I will repeat this many times. So from the viewpoint of this, it's still about 45-50% below the all-time high. The question is, in the last year, it has had a major stumble in terms of growth. The question is it an opportunity for us to enter and invest, or is it really a value trap? That's the question that I'm asking. Tomorrow is the financial year 2026 results. So after that, we will have a have a clearer idea than what I am going to present. So what they make, what does the company do? Essentially, a lot of this infusion and vascular access. So opening, sending medicines in and taking various fluids out of the body, and then this is also the reason triggered for another business vertical that they are entering into. So this is their main business. So infusion and vascular access. This is something that they have entered some time ago, these two. And in the middle, you see renal cath, dialysis, and interventional cardiology. These are relatively high-tech ventures. In renal cath, they are essentially beginning to make dialysis, which is a high-growth segment within this. And in India, there are a lot of people waiting for replacement kidneys, essentially. But it's not that easily available. So with no kidney replacement surgery possible for a lot of people with kidney diseases, it turns out that dialysis is their only way to survival. And with India leading in both DM and HT, that is diabetes mellitus, and hypertension, turns out that this is a common after effect. Kidney disease is a common after effect of DM and HT. So a lot of people who have DM and HT end up with kidney diseases, and they will need, depending on their condition, several times dialysis per week. So this is a high growth segment in India, and this is a segment that the company is newly entering. And the other one is even more high tech. This is called cardiovascular stents. This is interventional cardiology, wherein these are devices that are inserted into vasculature to change their shape so that there is no more blockage. These are called as stents, S-T-E-N-T. It's mentioned here. It's mentioned drug-eluting stents, and they are already beginning to enter this market. They already have quite a bit of expertise in this. This requires, this is not by no stretch of imagination, this is a low-tech product. This is high-tech product in terms of materials, in terms of design, in terms of quality testing, in terms of regulatory, because when it comes to regulations and standards for marketing these, it is required for these items to be of highest standards, and it takes several years of regulatory pathway before you can market this. So that is the other product that they are entering. So essentially, this is a consumable base that throws off the volume. But now they are entering into devices that are more invasive or more implanted and not just attached. So infusion, vascular access, and other things are serve outside the body, less regulation, and less worry about the possibility of infections. But the moment you enter inside the body, like in the case of stents, the regulations kick in with the highest level of vigil by all regulatory bodies in each country. There is a different regulatory body. In India, that is a CDSCO, and in the US, for example, it is the FDA. So far they were actually, I mentioned it's an IP manufacturer, not a low-cost assembler, but for a long time it was essentially a low-cost assembler. They manufacture their products, infusion pumps, syringes, and various other items using just plastics, and they were heavily dependent on the commodity pricing and the materials that were but now they're entering into a new field, which is dialysis and stents. And they have built quite a bit of know-how, technical know-how in this through the many patents that they have. And they have also acquired quite a few companies elsewhere in other. They acquired some companies some time ago in 2019-20, and then they built them to, brought them up to high margin businesses. Now recently they have acquired a couple of companies abroad, and they are now trying to improve the margin. So I'll also discuss the business implications of these acquisitions in a bit. So it turns out that they their business, 70% of their devices and this are essentially exported. 70% of their business. So this is good because in the situation that is today's situation where the rupee is depreciating a lot, they would you would expect that, oh, this is an export-oriented business, so they will make more money. But then it turns out, upon deep reading, what we will also realize is that a lot of their raw materials, a lot of their high-tech raw materials and the low-tech raw materials, all the things that they're getting are also from abroad. So it cuts both ways. I mean, the dollar appreciation or the rupee depreciation cuts them in both ways because their raw materials also become expensive. Of course, they're pricing their income will this, but it's not that they will simply benefit from the rupee depreciation. It's not that simple. It's a bit more complicated than that. So they have 12 plants across 4 countries, and they are also into high-tech manufacturing using robots, and they are now building capability for AI-based quality control and this. Within the country, they are the biggest exporter for almost a decade. So they have the track record of doing this. The customers are spread throughout the globe, about 125 countries. But most of their exports so far has been to Europe. They are beginning to enter into the American market, but American market brings with it its own challenges. The Bates family owns about 60+% of the 62.4% of the total number of shares. So essentially, they have the ecosystem, and they are now bringing in an IP-based, intellectual property-based distinction, and the experience of executing through regulatory regimes. This is what they bring in. Now, the next question is, what is the moat? Essentially, they have about 400 patents, and some more pending, another 10% more pending on various topics, on various different spread across their business verticals on intravenous catheter-based businesses, sugar needles, dialysis, cardiology, or this. And more importantly, they have. As someone who has experience in this field, I can tell you with a lot of confidence that it is not IP or patents that is going to save your business. Because I had very good IP, very good ideas, technology, but those things don't cut it for you when it comes to medical device business. In medical device business, the most critical aspect is your ability to survive through regulatory regimes that usually last. I have mentioned optimistically 2 to 5 year approval cycles, but usually it's anywhere between 3 to 7 years, practically in many different cases, especially FDA, CDSO, extraordinarily slow. Until the time your device is going to be approved by the regulator, you cannot sell it to the clinic. And if you cannot sell it to the clinic, how will you put bread on the plate? How will you pay your employees? So it's usually your ability to survive until your product is ready to to be marketed, to be sold. Essentially, that's a huge moat, because this company already has built products that are being sold in the clinics, and is actually dominating some of these because they are actually the third biggest catheter maker in this. So, and also it turns out, because of the way business is done, because of group pricing and other such this, for example, the United States rate contracts, it's these customers continue to be a little sticky. It's very difficult for the customers to switch. There are the teeny tiny details that vary in the specific products that will be used by the clinicians, that will require the clinicians or the clinical hospital staff to learn. Even let's say, instead of turning it left to right, or even a little bit of a change in the product, this might actually make a difference between life and death for the patient. So because that would require relearning of the entire skill set, or some of that skill set for these. And it turns out that for these clinicians, every moment, every second matters. So it takes effort, plenty of effort from the hospitals to switch. So because of that, customers are usually sticky. It's very unusual for them to to bring in new new vendors, new businesses, but that doesn't mean that it doesn't happen. It does happen. For example, that question also cuts both ways, right? Because for the interventional cardiology products or the dialyzer products that the company is bringing in, how are they currently solving the problem? Because that would also mean that these products that are new, that would require switching costs from the previous. So that all these things cut both ways. So we will have to be a little cautious on how we do this. But the most important thing, the other thing, is the ability to undercut MNCs and produce products that are better than China-based products. So essentially, it's a strong moat. Not just because of patented. I mentioned patented because that's what everyone says. But in my own experience, for me, the most important moat is from the experience of going through regulatory cycles, and the moat is somewhat thin. There is commodities, that is the regular legacy business of IV infusion pumps, etc. So there's also the growth. If you compare the growth of the industry versus Polymed's growth, you can see the global disposable market in the world grew by about 5 to 9% CAGR. So India's medtech industry grew by about 15 to 18% CAGR, whereas Polymed grew at about 21%. It's a strong compounder. Also, if you look at the India medtech industry that is taken for comparison here, many of the other companies are relatively small. Some of those companies were also presented in, I think, the previous ALD, I think, Coastal Devices, for example, is one of the companies that was one of the previous Alpha Learners Day. But these are all relatively small when compared with Polymedicure. Polymedicure is at least 10 times bigger than many of the other comparable. Many others are actually microcap companies. This is a proper small cap company. The China problem, the China situation is actually, a double-edged sword. On the one hand, there is the advantage that since COVID or just post-COVID, everybody wants to buy from, manufacturers that are not from China. So the China plus one team is playing out. But the problem is the Chinese have been flooding the Indian market with a huge amount of, let's say, cheap consumables. So although this company is for 70% of its revenue is coming from abroad, their Indian business is quite shaky, is being disturbed heavily by the China plus one team. So I mean, everything that I discussed has two sides. One is the China plus one advantage that the company enjoys elsewhere in the world, but that things down severely because of Chinese lesser quality products being flooded up. Essentially, you could say dumped, because they are not having the usual customers, people who would usually buy from them. Other countries that buy from them are not buying from China, and so Chinese people and the Chinese companies are essentially dumping them on poorly policed, poorly regulated countries such as India. So we have very little control over that in India, and the pricing level is quite below Polymed, and it's very difficult for the company to compete with the Chinese products in India. That is. So the structural tailwind is real in terms of growth, and but because China plus one cuts both ways, and the Indian business is being heavily disturbed by the China plus one acting against them in India. So these are the primary engines of growth that I see from studying this company. Essentially, the number of new products that are launched changed from about 10 to 12 earlier to about 30 per year, and in the next few years, about 50 to 80 new products are planned. And most importantly, they are entering into businesses that are relatively high margins. So the renal business, for example, is a high-tech business that has potential for high margin, also has potential for high growth. For example, 60% plus margins. Cardiology, for example, is another domain in which the margins can be quite high because the comparable stents that are imported from abroad are quite expensive. And considering that Polymed also is aiming to export this, it will be entering a space that is highly competitive and highly challenging. But if they break through, that would be a phenomenal coup for the company. And already they have experience in dealing with 125 countries. Especially, they are attempting to enter into the United States through the group purchasing sort of program and build to several $1 million, about $20 million. Already they have presence in Brazil and UK via their previous acquisitions. Recently, they acquired these companies, Ventracare and CPF. These are not their primary expertise. Bought these companies, and recently they have also taken some QIP funding. I think this was 23 or 24, if I recall correctly. QIP funding from various funders, various funding, and they have built capacity in Haridwar Metro, and some of these those that were built outside the Delhi national capital region, they've been able to execute quite fast. But in terms of achieving capacity in the Delhi NCR region that they were building up, there was quite a bit of challenge due to pollution-related concerns. So there are some spaces where execution can improve. And they've been able to, bring in 2 CDMO deals in 2026 and shift from domestic this were low margin. The other good thing is that they have been slowly phasing out of this selling to governments. This is another pain point in their balance sheet. You will see that getting the payment from state governments, for example. Sometimes for Polymed has taken for more than 1 full year. So that has been a major pain point. So slowly they are phasing out of doing business with the government. Again, this cuts both ways. The advantage of not working with the government is that you don't have to worry about payments coming in too late, because usually big hospitals, big private hospitals like Apollo, for example, Apollo Medanta, sort of big private players, usually pay by about 3 months. About 100 days is the usual time they take to make payments. But governments can take minimum 10 months, sometimes even up to 1.5 years. So that's a problem. But if you have government as a primary customer, you are having a huge customer. So this also cuts both ways. Cardio devices, the most important thing with cardio devices is that if they are able to build clinical partnerships and partnerships with the hospitals, they may be able to drive a huge amount of growth, both in terms of margins and in terms of sales, in terms of volumes. But the challenge remains that, like, your advantage is your disadvantage. I always say this with my students, is that your major advantage is usually also your major disadvantage. Your advantage in terms of your ability to manage the moat with respect to your existing legacy businesses is also your disadvantage, because the others also have the same moat. The other companies that are selling stents, for example, will have the same moat. The fact that you have the moat that others cannot enter your infusion pump business also means that you will take that much more time to enter the cardiology business. So it's not, it cuts both ways. It's a little challenging that way. The other is the entering into the dialysis business, renal care dialysis business. It's a huge growth vertical. I already mentioned the reasons why this is the case. It's just beginning to take off. The results are not yet seen. They have barely sold 400, 300. They've told that they will sell about 500 this, but the execution has not been that good. They sold about, I mean, in the end, about 400 or 450. They told that they will sell 500, but my sense is that they have sold about 400 business. It's just beginning this. Again, I'm cautiously optimistic about this business, and they have been expanding a lot in India in terms of multi-plant expansion, and they have also acquired companies outside, 2 companies outside. The challenge with the companies that are acquired outside is that their operating margins are very, very thin, razor thin, or already negative margin. So that means to bring them up to the margin that that Polymed is having, it will take. It is not a business in which you could convert the margins overnight into double digits. It is not that trivial in this business. It takes. You're looking at 5 to 7 years of this. It's a multi-year. This it requires plenty of patience to turn these acquisitions to be profitable at that margin levels. So, but what makes me optimistic about this is that their experience in turning around these companies in these acquisitions in the past from 2019, they did take time. That is also true. But in this business, time taken to execute is quite normal, quite acceptable in this business, in this domain. So they have experience in turning around previous acquisitions, and they have experience in entering into new domains and scaling up products. They have experience in establishing and exploiting their previous partnerships with their customers. So the primary this of my thesis is that they are entering new areas that are highly that have high moat, that are challenging. But the hope is that the question is, will they execute? Is their past execution and indicative of future execution? I will continue this, and then later because I'm running out of time. So this is their revenue and PAT records. What you see here, there's like a pretty much a solid PAT. This 24% CAGR PAT and net margin. Even after the recent hit is about 20%. Their original margin was much higher, but due to the acquisitions thinning them down, it has come down to 20.3%, and their revenue 10-year revenue CAGR is about 17%, and the loaded company. Just giving the basics here. So the operating leverage for this company, swamped by raw material swings. This is always a challenge in this business, raw material swings. So the other one is, outside the other income, core EBITDA is about 24 to 25%, not what is mentioned, and what they usually try to. And the other income in 25 financial year was 21% of the profit before tax, and this inflated the EPS by a very big this, and so that's another flag to note. So the operating margin for this company is about 24 to 25%, and the EPS reported is a little higher than what it actually is because of the income from other sources. So 20% from income from other sources. This is what I could gather by reading their performing some forensic analysis of their balance sheets over the last few years. So these are some of the concerns. None of them is a real red flag except for one. None of them is a real red flag. Essentially, this is mostly clean. Their books are mostly clean, and some of this is due to recent funding that they received from QIPs that have not that are still parked as cash, and so not really book manipulation. And the audit so far, I went through their AGM this and tried to look at for any audit concerns. Most of the auditor concerns, there's no real flags from the auditors. So most of the related party transactions are quite clean, and no product liability claims, no serious, judicial, this sort of legal cases that this over the last more than 2 decades of operations. So clean business. So the only flag that we could find is the last year's cash flow from operation by PAT was was the lowest in perhaps the historical or in the last decade. The usual is about 1.12, and the inventory days went from about 41 to 62. This is perhaps these are only the couple of flags in the entire case. The other one is that the free cash flow is not good in the last half a decade, nearly 4 to 5 years. The free cash flow is essentially negative. Perhaps some of it is also due to the equity funded, investment. So that's affecting the way this is computed. Essentially, I'm not able to see any serious evidence for fraud. But something to keep in mind is their inability to convert cash from this, and inventory creeping up is another concern, or some things we need to keep a watch on. So the question is this a transitory this or a structural reset? So a major trigger is the Chinese products flooding the market at 20 to 30% below market price. Essentially, completely disarms Polymed of its ability to competitively price its products to Indian customers, in particular in Indian customers. So also they reduced the guidance a couple of times actually in the last financial year, from about 20%, above 23-24% to 20% to below 20% to 16% until December. Their 9-month revenue was at 9.1%, and the profit after tax practically stalled at 3.6%. Tomorrow is the fourth quarter or the full year results, so we'll have to watch for that. Yes. So, and to bring acquisitions at 15% EBITDA margins to the margin at 24.2%, right? Essentially drag through this, and the hope is that there will be clearing of these overhangs, and essentially the margins will normalize. That is the optimistic take on this. So, if after this FC financial year 26 stumble, if we hope that this is transitory and it provides an entry point, and they continue to grow as per their history, then that's an opportunity. Or perhaps this stumble continues the other way. So we need to keep a watch. Then in that case, this becomes a value trap, and the derating will resume essentially. So we need to watch this. Again, for me, this is about their experience coming into play. Previously, the previous acquisitions that they acquired in 2019-20, they've been able to make them bring them up to the mark. Although it took time, the hope is that they'll be able to bring their recent acquisitions also to that level. Hopefully faster than earlier this. But again, I remain cautiously optimistic about this. We could not perform a proper, reverse DCF or TCF startup for this. So if you perform a DCF, you will see that the price is about 400. So it's not exactly the correct way to analyze this. So I essentially took analyze this using PE ratings. So far, The current P rating is about 40. I mean, yesterday, after the day before yesterday, it's about 46, 48 P rating. So almost at fair level or a little bit above this. So if you adjust the value of the 1,000 crore investment corpus as cash and which I don't know what it is. Yes, then the multiple is about actually 57x, which is actually pretty close to the 5-year average, which is 59. So after the recent recovery from 1,100 and something to 1,600, we are essentially sitting at a balanced picture. If we had entered at 1,100, the story would be different. But that's when we started speaking about the possibility of this company, and that is when I told when Puneet asked me to make this presentation, I agreed. And but in the meanwhile, this was from April to this in the 1.5 months since the company has the stock price has moved up a lot. Technically, Puneet says that 20-30% this should not affect your thesis. But my thesis is not primarily on the prices alone. My thesis is about the growth triggers in terms of the new businesses entered and in terms of turning around the acquisitions. So many of these are dependent on actual execution as opposed to mere price and sales numbers. More than that, it's a bit more nuanced than that. So this is the these are the three cases, bull bear and base cases. So what you see is that if the FY27 EPS is about 44 and we exit at the current approximately the current PE, you are already looking at a upside of about 31 to 50%. But the base case is that we are almost at the fair price. And note that the QIP pricing, if I recall correctly, was around 1,900, 1,880. That was the price at the QIP's bought shares. Right? So it's evenly balanced. I would say that there is about 40% pull and about with 40% bear. But so the de-rating cushion that I had in the beginning of while I began to prepare this, that was in April, is now gone. But I still think that this is a clean bet in terms of the future, what the company is expanding into in terms of the businesses itself. So that's my thesis. That's my primary take on this. So what are the risks? The risks are actually huge. There are many risks. I have attempted to just list 5-6 of them. The most important risk is Chinese dumping. This is huge risk, especially in the Indian market. It's a primary reason for the degrowth of in this year's PAT, for example. And the other is there is no real hedge against raw material inflation. Right? This is essentially something that happened in FY22 during the Ukraine war situation. They had serious problem with getting raw materials. So this is again. The third, I have mentioned 2-3 times, is their hook is severely diluted by the acquisitions. Note that bringing the acquisitions to parity, to bringing them to your level of to Polymet's level of margin is a long haul business. I mean, the previous acquisition took 5 years, and so there are, and also even though they come up, there are still integration challenges that exist. So it cuts both ways. And the others, right? There are cash qualities, regulatory frictions, new competition in the new vertical in which you have pretty much no experience, and the inability to control price. And there is also in the company's recent con calls, right? The growth. Especially in the export segment, the commentary is quite muted. They are not serious. They are not really this. But this is concerning because this is essentially an export-oriented business. But that also gives me the hope that maybe it's maybe they don't want to overcommit and under-deliver. That's this. But if that happens, for example, market will be very quick to punish that. The other is already having PE near its average, right? Already having a high PE. market will be brutally, harsh if any of their promises is not kept. For example, if they are not able to execute in terms of bringing the acquisitions to full margin profitability, or the regulatory risk that they enjoy, regulatory moat that they enjoy over others, come back to bite them when they are not able to face and succeed against the regulatory regimes elsewhere in the world. For example, against FDA. For example, FDA. Already they gave the reason for one of this taking so long to enter into the American market was because FDA's regulatory timeline extended beyond what they promised. But it is very well known for any simple professional in the field of medical devices that FDA is notoriously slow when it comes to approving medical devices. Just even before, and they gave the reason like COVID essentially built up a huge stockpile of cases for FDA to do. This is not true. Even otherwise, FDA is very slow. That's this COVID. I mean, maybe COVID also made the situation worse, but that's not the primary reason why this is the case. So essentially, there are some serious problems. Essentially, dumping and commodity or raw material, inflation, and this is what we need to keep watching. This is what will decide whether we are entering a bull or bad phase. The other only this is essentially hope and optimism. So what we can test is tomorrow's results. Tomorrow's result, we'll have to check what the revenue, whether they are actually meeting their guidance or whether they are cutting their guidance, and what the margin is, whether the cash flow from operations and the profit tax recovers from the poor, show in the last whether they are able to bring any improvement in terms of their margins of their acquisitions, and whether they are able to build to scale in the United States. So now that's a huge hope. If they can ramp up, their customer base in the United States, that will be a huge boost. But the truth is that their experience in operating abroad, although they are an export-oriented company, their current customers are essentially located in the European Union and not that much in the United States. So their experience in working with the US, it's a different model. It's a different. It's actually extremely different from the European model. So you need to be. I remain skeptical about their ability to penetrate the American market. So this will essentially dictate whether the free cash flow is will jump back from negativity of the last 4 or 5 years. So we'll also have to monitor their inventory days and what happens to their other income share of profit before tax, because last time it was about 20%. And is there going to be any further equity dilution of this? So we'll have to watch. So tomorrow result is the primary high information event. So we'll have to keep watching and keep reading their phone calls and try and understand what the way forward is. Right. So this is the technical. If you see, most of the the company has recovered from most of the from a low level below all key EMAs to a value above the 3 EMAs, 10, 21, 50 EMAs, for example, but still below 200 EMA. So essentially had a 10, 21 crossover at around 1,300. So has a very healthy EMA regime. As of now, definitely a momentum stock probably, because you see the 10 EMA, 21 EMA, 50 EMA all lined up. But this was not the case when I and Puneet discussed this in April. When it was essentially at a low point. I still salute Puneet's this to identify stocks at the rock bottom. But I never invested in this company. I was only studying it. So this is again, momentum is building. Is this a short-term momentum burst only that's going to last for a few days or a few weeks, and will it sustain? That's the question. The other is that a lot of it is dependent on what happens tomorrow. I mean, what this price structure that is that is established as of now. Will it stick? Now tomorrow we will know. Besides, the last 2 days there has been a price increase, so I don't know. Last 2 days, the price increase was of more than I recall correctly, more than 10-15%, a lot actually. So, just 1 second, let me put the power. Yes, so that's the story, the technicals. So essentially, my own reading, this is not a recommendation. My own reading and lesson learned is that we buy and accumulate at these levels. At the current market prices are lower, but definitely don't buy above this level. This and have medium conviction due to the price movement in the recent weeks, and also due to the many risk factors that are there in terms of regulatory mode and in terms of regulatory challenges. In this minimum, you are looking at 3 to 5 years of time horizon. This is not a company that's going to be able to turn around acquisitions in a short time. It's not a business that's going to bring in those huge growth this next year. It's not that. Entry zone is definitely the current price or below. Definitely not advisable to go above 5% of the position size. The results tomorrow, so we'll know the story tomorrow. This is essentially, I'm essentially framing the bit how you want to size this, how you want to play this is in your own hands. Definitely not a recommendation. Please do check. And with this, I conclude my talk. I hope I kept in time. Sunit?
Yeah. So you have quite went into detail. Actually, I liked the presentation. I was listening very patiently. And one of the things which you are highlighting, and I just want to reiterate to people, I think this company is redefining itself in the last few quarters as well as few months. So it's not a short-term thing. As you clearly highlighted, minimum 3 years. I think that's the horizon people should be looking for this company, not as a momentum play, not as a turnaround play at this point, but
Yes.
something which can be visualized for 3 years period. The tailwinds are huge in the medical equipment industry, and it's kind of an import substitution kind of a thing. But as you said, Chinese dumping is also there. So a lot of
Also,
factors.
India is okay. Something that I can say as an expert, as someone who works in this field and who understands the government's priorities, working for the government, the sort of grants that we are asked to author, the sort of things that the government is asking us based on, as a faculty member in an elite institution, I can tell you is that the government is really, really keen on, I mean, everywhere in all domains, government is keen on cutting down its forex expenditures, and it turns out that the medical device imports is a huge burden on the exchequer for in terms of this. So the government is, willing to invest thousands of crores into research and development so that they will, they will be able to cut the import of medical devices. I mean, even recently there was a multi-thousand, like $1 billion grant call came for this, but they were focusing primarily on the big medical instruments like MRI, sort of those are really high tech, deep tech. This, but the government is encouraging of all sorts of this wherever you are able to cut down the dollar this, and this is a big bill for the country. All the products that we have in any hospital, most of the products that we currently have in any big hospitals, especially in the operating theater, are all imported, including the linen, for example. This is our state. This is India.
Yep. And if you go to this kind of company can be easily done as scuttlebutt. So if you go to hospitals, you can check which kind of components are being used from polymer, which kind of equipment. So of course, there are some on the bigger stents and other things, which will take some time.
I have not actually done that, but I have the connections to do it. I will attempt that and keep you all posted.
Yeah. So the rest of the questions you can think from the chat and answer there. So in the interest of time, we'll try to move ahead. Vardhan, thanks for your time. I think for the first time you're doing, it's a great presentation from that angle.
I could have done better. Thank you very much for your patience, Puneet. How to stop sharing? Shall I stop sharing?
Yes, you can. So we'll move to next presenter, Pramod.
So, am I audible?
Yes, you are audible and your screen is also visible.
Yeah, so I can start now.
Yep.
So, I would start with a statement by John Sculley. John Sculley is an American investor, investing in startups, entrepreneur, and one more thing is he was a CEO of the Apple company for almost a decade from 1983. So the statement is the future belongs to those who see the possibilities before they become obvious. So as investors, if we can see the possibilities happening in the sector or the companies before they become obvious to the market, we can pick up the company early and generate the alpha. Same way for the company, the management, if they are very much open for this to see the possibilities, they can progress in their the business also. So this statement is not picked up by me, but this is a statement picked up by the management in their last financial year. So that is what they say, that they are going to grow their business, not only the revenue, but their margin, increase their margin. And they are the ones who are seeing the possibilities in the sector as well as the associated sectors so that they can grow. The company is in the automobile sector. Just 1 second, is the Zoom, this also is coming on the screen? I'm not able to minimize it. I'll just minimize it. Okay. So the company not only just wants to grow, but it wants to turn its vision, the growth, into velocity. The company I'm going to speak about is Belrise Auto Industries. It is the auto ancillary industry. I am Pramod Br presenting. This is my third presentation in the ALD series. First was CDSL. Second was Gala Precision Engineering. And this is my third. At the outset, I thank Punitji for giving me this opportunity, as well as constantly supporting me for my investment career. I also thank all the ALD members who are present here, for presenters as well as the members. Thank you. So let me start right away. Coming to the company overview, this is a Tier 1 automotive OEM to two-wheeler market. Mainly in the two-wheeler market, it has got 24% market share in the Indian two-wheeler metal components. It is increased its presence in four-wheeler passenger vehicle as well as the commercial vehicles. It has 22 manufacturing facilities across 10 cities in 9 states. We can see the map here. It is a company based out of Maharashtra. Majority of the factories in Aurangabad and Pune. And it has companies in North India, the factories in North India, Central, Western, as well as South, where they are very close to the automotive hub. The two-wheeler, four-wheeler, the companies like Bajaj, TVS, Tata Motors, wherever they are, Maruti. So they have their plants nearby. So logistically, it is easier them to supply at a lesser cost and a faster pace. The key markets for their products, domestic 94%, and also 6% to Austria, Slovakia, UK, Japan, and Thailand. Coming to the company's growth, it was incorporated in 1996, 30 years back, as Badway Engineering Company, the name of the promoter, the chairman who started. So it was rebranded as Belrise Industries in 2022. And last 1 year back, it was listed on the NSE as well as the BSE main stock exchange. So in this growth, anyway, we'll be going in detail in the further slides. What is more striking is, for the last 10 years, from FY 2016 to FY 25, in the last 10 years, the domestic two-wheeler industry has grown at 1.4% CAGR, which is very, very meager. However, the company has outgrown this sector growth. It has grown its CAGR at more than 11.5%, almost 8x the sector growth. How it has done all these years? By increasing the content per vehicle from 4,000 rupees to 12,500 in the two-wheeler, and also becoming a parts to assembly maker, which we'll see later. These are the products which the company makes: automotive, two-wheeler, three-wheeler, passenger, as well as four-wheeler commercial vehicles. I highlighted the main components they make: steering column, shock absorbers, chassis, air tank, bumper, as well as the battery containers. They have a small amount of non-automotive also from the polymer component, where they supply the fruits and vegetable tray, handle, and base for the refrigeration parts, as well as the solar panel component renewable parts. The business capabilities, it has 4 major vertical division: sheet metal division for fabrication, plastic and polymer division, suspension division with including A to Z from the design, the final testing, the emission control, machining, surface treatment, And also the fourth one, the e-mobility, that is the electric powertrain division, where they're developing and manufacturing motors and charger components. All these are vertically integrated from A to Z. It will be done in the single setup. It has 1,000+ product portfolio, processes around 60,000 tons of steel annually, 2,000+ employees and 5,500+ job workers, that is contract employees, and 800+ industrial robots. Strengths of the company: number one, market leader in the precision sheet metal for automotive components. The advanced engineering powered by innovation and technology, which we'll see what they have IP. Vertically integrated manufacturing for the diverse product portfolio. Long-term client relationship driven by trust and performance. We can see the customers here from last 9 to 25 years, almost major two-wheeler, three-wheeler, and four-wheeler. Tata Motors, JLR, the Bajaj, TVS, almost most of them are their customers for over the long years. The fifth strength is their EV agnostic product portfolio is aligned with India's growing EV market. And the sixth strength is the experienced promoters and the management team. It is a promoter-driven company, but supported by managed the professional team and run in a professional way. Mr. Shrikant Badwe is the founder promoter and is still running the company. His second generation, both the sons Sumed and Swastit are already in the company and the lead are taking the second lead roles. So there is no problem of legacy for the continuation of the business. That is taken care of, already incorporated. All are well qualified and having good experience. And the chairman has around 30 to 40 years experience in the industry. One of the directors he was there is having 24 years experience in automotive OEM, and he was formerly associated with Tata Motors. So he adds to the business acumen, the extra experience to them. Coming to the shareholding, the promoters currently holding 66.46%. FIIs have a sizable stake of around 8.8%. DIs have increased from 4 to 10% in the recent quarter. Public holding is around 14.5%. In the last December, there was a block deal, 6.56% stake sale around 153 rupees rate for around 897 crores. It was fully bought by the SBI Small Cap Fund, 5.8%, and BlackRock had additional stake by this block deal. So this stake was not diluted by the main promoters. Mr. Shrikant Badwe still has 59% stake, and his son and family have majority hold. One promoter group entity which was holding this stake of 6.5%, that was divested to accommodate the new institutional investors. Coming to the financials, the financial breakdown, it has almost close to 80% revenue coming by the manufacturing sector. 20% it does the sale of traded goods in the same auto components only, because whenever it is a customer whom it has to supply, the allied products also it buys and trades that along with their the components. Coming to the vehicle type, 80% of the revenue comes from two-wheeler plus three-wheeler. Around 12% comes from four-wheeler, that is commercial and passenger vehicles. 6.6% other vehicles like tractor and other rest. Coming to the powertrain. Powertrain means whether it is run by ICE engine, that is petrol or diesel, or by EV. So close to 74% of their products are powertrain agnostic. That is, whatever products they make, it can be incorporated by the customer to any of the two-wheeler, three-wheeler, four-wheeler, yes, irrespective of whether it is ICE engine or a EV engine. So that is a strong positive or a plus point of this company. Coming to the profit loss statement, for the last 4 years, it is significantly increasing the revenue year by year from 5,300 crores to 8,200 crores in the last FY. This year, the FY26 and Q4 results are today, actually coming today by evening. So it is not yet incorporated. Operating profit is slowly and gradually increasing in a positive way from 755 to 1,020 crores. And net profit has increased from 262 to 355 crores. So last year, that EBITDA, or the operating profit, has crossed the 1,000 crore. The EBITDA margin is around, combined for the entity is around 12%. It has been maintaining that range for the last few years. Initially, it was 14. Now with the acquisitions as well as the more advancement into further factories, the capex, The combined it is for the last 3 years around EBITDA 12%. It is going to increase. That is what my thesis is. Manufacturing EBITDA is 14.3%. The trading EBITDA is less 6%, but however, the revenue from trading EBITDA is also less as of now. One more important thing in this profit loss statement is this interest. It is going to decrease in this year and the further. Why? I am telling in the next slide. Coming to the balance sheet, it's a strong balance sheet. There is a deleveraging of the balance sheet. Last year, the IPO proceeds, they made around 2,150 crores of fresh issue in May. That is exactly 1 year back. 80% of it, around 1,600 crores, was used for debt repayment of the principal as well as the interest. 20% used for the general corporate purposes. So debt has significantly reduced, and net debt equity has come down from 1.5x from FY22. Pre-IPO it was 1.01, and post-IPO it has come to 0.16. And currently it is somewhere around, the debt is around 750 crores. So this is this is in the Q2, it was around 1,400 crores. Currently it is around 750 crores. So for the FY25, the capex was 800 crores. It was by internal accruals. Chennai plant, the commercial, these are the capex for a commercial vehicle plant. Pune plant for a EV hub, Bhiwadi plant, and also the capex is for the integration of the business and the new developments happening in the company. The cash flow statement, the operating cash flow has been positive for the last 4 years with good management of the cash flows, and it is heavily investing for the capex year on year, and last year the capex was quite high. The ratios has been quite stable and well efficiently managed. Debtor days in the range of 60 to 70 days, inventory days between 30 to 40 days, payable days between 40 to 59 days, and a cash conversion cycle of around 54 days, and working capital days of around 30 to 34 days. So with this, the ROC, it is maintained stable around 14%. So it is maintaining a healthy ROC in spite of heavy capex, showing the efficient capital utilization. So till now, I explained what the company is doing. So you may say, what is new in this? Any company, manufacturing company, it is same thing. It is running for 30 years. They've grown the business. They know what they're doing. And it is positive operating cash flow. But now what makes the presentation much more interesting? So till now, I have proved that company is a fairly reliable one. No obvious red flags. Good management. They know what they're doing. They are increasing their presence in the domain in the same industry with efficient capital utilization as well as the appropriate capex utilization. So how is the management now further going to improve now or improve the business? So basically this is the next part. That is why I like this company. The very idea of presenting in this ALD series is whether the company is generating the alpha. As an investor, I'm interested whether the company is going to give me alpha or the extra growth in the business, thus in my investment return for the next 2 to 3 years. Definitely, yes, that's what I believe. That's why I'm presenting this. Coming to the first reason, in addition to the deleveraged balance sheet, which I've already explained. So the interest has gone down and the PAT is definitely going to increase in this year. The future direction is the first thing why I like this. This company is going to grow. In the two-wheeler segment, it has new products leading to the increased content per vehicle. The current at FY25 was at 12,500. It has done a steering column, which is a IP that is one manufactured one with a tilt, which is a unique one. It is going to add a 1,500 rupees per vehicle, filter of around 800, brakes of 2,500. So making the new cost per vehicle around 17,300 up to Q3 of FY 2026. Second thing is, as per the recent Chrysler report, there is premiumization happening in the two-wheeler industry. Last month, I changed my two-wheeler, the Honda Activa I had for the last 15 years. I was driving the 100cc. So after myself and my wife drove the 125cc of Honda Activa, we wanted to buy the 125cc. That is as a family perspective. And you imagine the youth, they want all this strong strength, energy vehicle. So the 125cc motorcycles, scooters, the buying percentage is increased drastically, more than 1.5 to 2.5%. So the premiumization is helping our company Belrise to increase the cost per vehicle. The components which they supply for 100cc compared to 125cc, the cost is more for the 125cc, the same components with better performance. So just for example, the chassis, which is the main component of this company, for the 100cc, it is 2,500 rupees. For premium 125cc, it is 5,500 rupees. That is 2.2 times more than that. So this is the second way the company is leading into for the future direction. And in the same thing, if you see the recent data, the four-wheeler automotive component market is 22.7 times larger than the Indian two-wheeler automotive component market, around 3,037 billion rupees. So 57% of the market share is by four-wheelers and only 21% is by two-wheeler and rest others. So the company is now strategically moving from this 21% TAM to 57% total addressable market. So what it is doing, already it has share in the four-wheeler and commercial vehicles. It is expanding the revenue share. Currently, it has 12% share. It is doubling that in the next 2 to 2.5 years through the new model penetration, new customer acquisition, and cross-selling. I'm not going in detail in this because it will take more time to explain how it is expanding that. But the company is explained in the investor presentation, and I'm pretty convinced that in the next 2.5 years, this company is very well poised to take aggressive market share in the four-wheeler as well as the commercial vehicle segment. Second thing is the proprietary components are the IP, intellectual property. This company has already set up the new product development team with 163 members. In the last 3 years, it has manufactured 8 IP products. So with this, it is becoming a IP development company. The company doesn't disclose separate R&D expenditure in this annual reports, but it incorporates this cost as it is incorporates the costs into overall manufacturing and product development expenses. Not only it is manufacturing by itself, it is having joint development with the premium passenger car companies, a French auto component player company, premium, the top Indian two-wheeler 3 OEM companies, what they want with their joint collaboration. It is developing their the products for them with the proprietary components technology what they already have. So this is the second reason why I think it is going to progress in the next 2 to 3 years. Third, it is currently a tier 1 assembly. Tier 0 is what we see all these Maruti, Tata, Jaguar, the TVS, Bajaj. They are tier 0 companies. The component suppliers, they are tier 1, like what we have at Belrise. So all these years, it was manufacturing these individual components and supplying to them. These companies had to assemble themselves. Then slowly what this Belrise did, it started to weld one by one to one. So chassis and the side stand, front fork like that. Now with its proprietary products, we can see for all the segment, two-wheeler, three-wheeler, four-wheeler, the light blue of the proprietary segments, it is doing a sub-assembly. So what used to make separately, it is supplying the tier 0 supplier with a sub-assembly. So this is a great advantage for the buyer. Say for a Bajaj Auto, it had to take say around 10 days to make this assembly. It is getting on the day 0 itself as soon as it purchases is from Belrise. So what makes advantage for Belrise is this, it is killing the competition. Once it has a strong the entry into one, say Bajaj Auto 125cc bike, it is very difficult to displace another by another company because it is giving a sub-assembly which is very much convenient and easy for the Bajaj Auto. So this is a strong play which the company is focusing on to increase on. So that is becoming from tier 1.0 to tier 0.1, 0.5 supplier. So this is with respect to what they already have their presence in two-wheeler and four-wheeler, how they are progressing their business in the existing business. So next is what is called the merger or the group structure simplification. If you see, we had a presentation last time about OBSC perfection, and almost most of the two-wheeler companies like Uno Minda, Gabriel, they have a lot of multiple unlisted promoter-owned entities. This leads to a complex group structure with lot of related party transactions. like buying from the same companies, selling to them again. So there are a lot of related party transactions. This Belrise also has multiple components. The company management has thought of merging them. The main two bigger ones are the BAPL as well as the EIT-PSL. So the revenue already these have generated in the last financial year. The BAPL has generated a revenue of 1,421 crores, EBITDA of 13% and a PAT of 5%. This Eximus is also around 600 crore plus revenue, EBITDA of 12.2% and PAT 4.47%. Already cash generating businesses, they are getting merged into the primary Belrise company. Why? What is the rationale here? So the management believes, and what it has explained is, this reduces the relative party transactions by 1,150 crores. The combined entity. So if you remember what I presented in my first slide, the Belrise is already a market leader with 25% market share, 24% market share in the metal sheet industry in the two-wheelers. So with this merger, the combined entity is going to have a 25% market share in the Indian two-wheeler plastic as well as the polymer components. They're more so encouraging it to become the Tier 0.5 system assembly system. So it is going to increase its market share in the plastic and polymer industry in the two-wheeler segment. This merger, the single entity after the main company, is so with that it is going to increase the content per vehicle by 3,000 more. So 17,300 to 20,300 rupees in the two-wheeler segment. More interesting is this transaction is executed at the close to book value, around 8.3 PE of last financial year, when the PE of the listed Belrise entity is around 30.9. So this has been overseen and taken care by the reputed firms like E&Y and JM Financials. This process has started even before the management came with IPO, but all the NCLT, whatever the stock exchange, all these approvals is going on, and it may take 18 more months to happen. So this leads to immediate EPS accretion. Revenue increases immediately by 1,000 crores. As soon as it happens, the last year revenue was around 8,200 crores, 1,000 crores is added. PAT increases by 110 crores. So what it finally leads to? It improves cash flow visibility for an investor like me, and also the investors or HNI or the institutes looking at it gives a better valuation because it gives a better cash flow visibility. Same thing has happened in Uno Minda and Gabriel last 12 to 18 months. They're also undergoing the same process of merging the group companies, and the market is taken care of it and also rewarding them by giving a better valuation. Fifth one. So the company is looking into other verticals which are close to it already existing automobile verticals. So next among them is the acquisition of a company called H1 India. 100% stake was bought in March 2025 for 190 crore rupees. This was a subsidiary of a Japanese company which is listed in Japan but had a factory here in India. It wanted to exit from India, and then Belrise acquired it. It is located in a strategic location somewhere, I think, in Rajasthan. It has a hidden land value also, good R&D setup, and with all the components coming in. Main advantage of this is, in addition to the factory, it is getting the technology, which is high tensile steel technology. The normal steel, which is used for automobile, has a strength of 600 metric per annum with 2 mm thickness, whereas this high tensile steel technology provides strength almost double of 1100 MPa with half the thickness size, 1 mm thickness. So that is a great advantage. If you see the chassis and the whole body, it reduces the weight by almost 20 to 30%, which is a great advantage in large SUVs and EVs. And this all happens without sacrificing the 5-star safety rating. Second advantage of this is the high tensile steel technology is the making of the battery enclosures in EV. So if you see the battery enclosures for the EV, it is not just a box, it is more than a box. Composite materials are used, high tensile steel is used for properly arrange the batteries to avoid leaking, avoid overheating, and this high tensile steel provides extra coating so that on any side impact, the batteries are not damaged. So this technology is very advanced, and that is where the company is gaining the extra addition. So by incorporating their additional already existing chassis manufacturing, bodybuilding manufacturing, they're gaining extra technology to proceed further. So not only the technology, the one more new Japanese four-wheeler OEM is added as a customer and increased penetration in the two-wheeler Japanese OEM market also. So with this, in the four-wheeler, the content per vehicle has increased by 15,000 rupees to somewhere around 45,000 rupees is the content per vehicle in the four-wheeler for this company. Next is the acquisition which happened also in the last few months. The company is called Mac Filters and Equipments Acquisition. The company paid 16.5 crores for this, and it has made a new vertical for this, which is a filtration system, which the company didn't have before. So with this, the advantage of this is the new company has a filter producing line. Polymer component, the Belrise has with the merger of the the underlying companies. It is growing to produce the integrated filtration systems, which is again a tier 0.5 assembly again. With this, it is going again, increasing the content per vehicle in both two-wheeler and four-wheeler. With full capacity utilization of this line, it is going to have a revenue addition of 125 crores, and it is again having extra clients with this acquisition. So both the acquisition are related to its existing business, going into developing a new technology, getting a new technology. One second thing is going into a new vertical, thereby getting new customers as well as the penetration to the existing customers. So next one is the defense and aerospace. Morning we had a beautiful session by Shekharji. So he explained beautifully how Sansera has developed from an automobile company and slowly progressed to aerospace as well as defense. And this year, Concall, they've given a strong guidance how they're going to how to make the acquisition and incorporate into the main entity and how they're about to grow. Similarly, Belrise, it is doing this in the last, say, around 3 to 6 months. This is a new development. First and foremost, in this defense, aero as well as space, that is not just aeroplane, but even the space industry, it is spreading its wings. First and foremost is the Plasan. Plasan is a company in a place called Sasa in Israel. So it has developed a collaboration. I would say, after this presentation in the evening, just visit this website of this Plasan company. It's a beautiful company giving like state-of-the-art technology, what it is producing for the mission critical vehicles. So it is the Plasan is an armor protection solution producing company for defense, combat, civil, in all the land, sea, as well as air platforms. It's a global leader in armor as well as survivability technology. Morning, Shekhar sir was saying, drones are required for commercial in the future, not just the army. Same thing, this is what technology is. It is providing for civil survivability also, already this Plasan company. So in December 2025, Belrise entered into an exclusive 3-year agreement. So the main agreement for the product, what is called Atom, all-terrain electric mission module. It is a self-propelled electric platform that is like a power trailer that can be hitched to military vehicles to provide extra payload, energy, mobility. It can be remote controlled or robotic as well as autonomic movement possibility. So this is a picture explaining that the Atom as such, it can travel by itself, unmanned vehicle, remotely controlled or robotic self-autonomous mode. It is run by this battery component, EV component. This company has a 3-point quick connection that is patented one, which quickly connects to any of the army or the defense vehicle, like a trailer, which can go on any terrain. This provides improved mobility as well as it provides extra power to generate like 4-wheel drive, 6-wheel drive, including 8-wheel drive for these vehicles. It can carry extra payload. It can carry drones. It can attack by drones. It can counterattack by countering the drones. There is a beautiful video, if time permits, it's a 2-minute video. I'll show at the end of this presentation what this Atom can do. So what is the Belrise's role in this Atom? So it is a 3-year exclusive agreement as of now. The Belrise is going to manufacture in India under Atmanirbhar Bharat scheme, initially as a prime subsystem supplier for Plason's global operations. Plason is already supplying worldwide. So for this parts made in India, India will support military projects worldwide. And the Belrise main role will be to bring the atom production and development as a solution to the Indian defense market. So this is with the first entry into the defense. The second is the second company, which is the complete acquisition. The company is called SDM in France. In December 2025, this was acquired, which is a specialized aerospace manufacturing equipment from a liquidated French firm. The Europeans, this is a space manufacturer, which is specializing in high precision machine parts for aerostructures, aero engines, and robotics. These are the key products like aluminium, specialized aluminium, titanium axles, and the marquee customers are the world's largest OEM, that is Airbus, leading French combat aircraft OEM, that is the Dassault, which makes Rafale, leading French helicopter OEM, that is the Eurocopter, which is a part of Airbus industry. In addition to that, one of the leading French robotics OEM. So this Airbus also does space satellite components. Hence, with the acquisition of this company, the Belrise has acquired these as clients, which is a huge boost for their entry into the aerospace space market. And this acquisition was done at only 1/10 the FY27 projected sales because it was a liquidated firm. And what Shekhar explained in the morning, in the Europe, especially UK, France, Germany, these Airbus industries and all, they're finding it difficult to run the industry because of the cost as well as the labor issues. So this was acquired at a very cheap rate, and it's a very good company to have a market customers. In addition to that, to run this company, the Belrise has onboarded a former CEO from a Airbus subsidiary company. So he will be the guiding person and the leading force in this segment for this company. Coming to the last acquisition, it is a Chester Hall Precision Engineering, a UK company. It was acquired just 2 months back in March 2026. It is a specialist in precision machining aerostructures, aero engine parts, and satellite parts. It operates across a range of aerospace alloys. So Belrise still now, as automobile component manufacturer, it used to have technology for stainless steel as well as aluminium. Now it has acquired technology for high tensile steel. Now it is going into high-grade aluminium, titanium, and all the specialized alloys used for the aircraft engines and the aircraft industry. So this company is Chester Hall, all the international certification which is required to manufacture and supply the leading customers. So the two marquee customers which were acquired with this acquisition was, the first one is a world's largest aircraft and the space OEM manufacturer, that is again Airbus. So this company is the single source supplier for the Airbus Neo program since its inception. So it is involved in the design and development of satellite structural parts also. The second marquee customer is the leading French aircraft engine OEM. It is anybody's guess? Yes, it is Safran. This Chester Hall is involved in the design and development of the thrust reverser as well as the nacelle parts of the Safran. And again, single source supplier for multiple programs. And it was acquired at a cheap dirt rate of around 6x the enterprise value of the EBITDA. Currently, it is a high EBITDA margin generating business, or say more than 20%. CI25 annual revenue of around 18.5 million British pounds, EBITDA of around 2.2 billion British pounds, and acquired for just 13.2 million pounds. That is almost 0.6x the yearly sales revenue. So these are my points, which are the pivot points, which I think probably very definitely, I believe it is going to put this Belrise Industries into the next orbit. So that is my thesis. So there are a lot of moving structures in this company. I'm not able to generate a DCF. or gave a bull bear case scenario with respect to the fundamentals. So I'll go directly to the company details. Currently, it has a market cap of 18,650 crores. Current market price was around 210 rupees on Thursday evening when I finalized my this presentation. Face value of 5 rupees. It came with IPO of 90 rupees and listed at around 100 rupees. Strong oversubscription by all retail, QIB, HNI with 40x. And in the last 1 year, it has doubled from 100 rupees to 200 rupees. This is the daily chart. We can see it is moving in an uptrend channel. So whenever it goes up, it comes back to the lower end of the channel. It stays, try to goes up, and again it is going up. Similarly, in the weekly chart also, it is running in an upward trend, which is a good sign. And my entry was around 160 when it came around last time near the floor of this channel. So with this lot of fundamental changes in the going on, I definitely believe it is going to go in this channel and going to cross this upper border of the channel, and we'll have a breakout of this. So risks involved. Obviously, automobile is a cyclical industry, depend on macro as well as economy linked. It's a highly competitive industry. Raw material price volatility, it's a commodity industry and a margin pressure will be there. The management failure of integration of new verticals or acquisitions is a risk. High risk of related party transactions is there. Anyway, the management is addressing that with the merger. And low margin trading revenues, the revenue from the trading is having a low margin, which we need to see how the management is going to address. So what I need to track as an investor? The result is going to come today by evening. Tomorrow morning, 11 o'clock is the con call. I'm eagerly awaiting for attending the con call. The FY26 results and the management commentary tomorrow, as well as annual report, will give a strong sense how the management is looking at the recent acquisitions, how it is going to incorporate and how it is going to grow. Like the way the Sansara has done in this recent con call, I'm expecting a lot from this management, and we need to see what is the management's message on the future path. So how it is going to scale up. So in the summary, these are the pivot points which is going to take this in the future orbit. As the morning presenter said, this company is going into in a transformation stage, both in the capability as well as the corporate, that is corporate by the group merger. So this, I believe, definitely is going to be at least a doubler or a tripler in the next coming 2 to 3 years. Thank you. Punish, you have 2 minutes time to show the video of the Tatum vehicle.
Yeah, please go ahead. Great presentation, by the way.
Thank you. So initially, I'll make it 1.5x. This is the animated video.
Mhm. But it will again share it possibly, I think. Very good.
Okay, one second. So initially is the animated video what this item does, and at the later of the video is the actual thing what it is doing.
But we are not able to see it if we have started it already. Pramodji, you are sharing it? We are not able to see it till now. Pramodji, you are able to hear us? We are not able to see the video. I think other guys are able to hear me, right? Just give me a thumbs up or something if you are able to hear me. I'm not able.
Yes.
Yeah, okay. I'm not able to hear back from Pranabji. Okay. So we'll go to the quiz part of it. Let me share my screen. Let's see if Pramodji joins back in between. So it's again fastest fingers first. Let me open the.
Okay, thank you. Thank you.
Yeah. So yeah, I hope you should be able to see the PPT. So audience time here and question number 5 is coming here. Question 5 is coming up. So Panacea Biotech is currently undergoing a massive valuation infection. What is the primary clinical catalyst for this one? Okay, lot of answers. We can stop here for next question. So question 6 would be coming up. Polymedicure is a debt-free compounder. What is there? And approximately 4,400 patents, and they are ranking in which medical device category? A little tricky question for all of you. Okay, we can stop it here for next question. Question 7 is coming up. Okay, this is for the V2 retail. Which parameter indicates the strong recovery in performance? Okay, last question of this quiz. Question 8 would be coming up. What is the single biggest near-term risk for polymedicure slowdown? Okay, I will revisit all the answers and we'll share the winners once they're available. So we can go to the last section of the day where 3 more companies are coming up. I will hand it over to Ankit. Let me, Ankit, give you a co-host rights. Yeah, you can see now if we get the permission to share, Ankit.
Should I share now or?
Yeah, we can start now. Actually, we are a little bit running late now.
Okay, just hold on.
And thanks, Ankit, for putting your hands up for 2 times this yearly. Great to see that.
Let it. Because the market fell so much in March, many opportunities came up.
Correct. Yes, we can see your screen. You can start.
Is it visible?
Yes.
Yeah. So Shekhar Bhai earlier was talking about some mental models which we can use to select stocks or study them. So there is one mental model here in this image. It was posted on Twitter a couple of years ago by Mr. Prabhakar Kudwa. Prabhakar Kudwa is the guy who made the PEAD investing very popular. Okay. So he says that if there is a single most potent determinant of stocks future returns, then it is the change in margin trajectory. Okay, margin trajectory basically transforms the whole company. Let's say a company going from commodity to some specialized products. One example for the recent past would be Gaware High Tech. It was operating in single digit margins, then it went into specialized films, and the margin trajectory change, and the stock since have returned 5 to 6 times given. Okay, so the stock I am presenting today is Jubilant Ingrevia, and I believe the company is very much on an inflection point where its margin trajectory will change, not by 1 or 2%, but by very good 5 to 6% change might happen in their margin trajectory. And let's see. Firstly, about Jubilant Ingrevia. Jubilant Ingrevia is a demerged entity from the Jubilant Group, which is now named as Jubilant Pharmova. Earlier, it was named Jubilant Life Sciences. Okay, so Jubilant Life Sciences earlier had all this pharma business, this chemicals business, chemical intermediaries, specialty chemicals, and life science ingredients all mixed into one entity. So they proposed the demerger in 2019, where they separated the pharma business, which is now known as the Jubilant Pharmova itself, and they created a separate entity called Jubilant Ingrevia, which had all these chemicals businesses, including the life science chemicals, the chemical intermediaries, the nutrition ingredients, and your specialty chemicals as well. And the demerger became effective on February 1, 2021, and the shares started trading around the same time only in February of 2021. So before going into the company deep dive, let's see what has happened with the chemical cycle in the last 5 to 6 years post COVID. So what happened was in 2020, COVID happened, and just after COVID happened from 2020 and 21 itself, companies globally started sourcing their raw material needs of chemicals outside China. So China had a big around 60-70% share in the chemicals market, but from 2021 what happened was the negative turned against China, and hence the Indian chemical companies became massive beneficiaries of it. Not only they saw demand picking up from the sourcing shift, but the chemical but since Chinese supply totally stopped, the prices of of the underlying chemicals itself shot very much, and many chemical companies around that time gave huge returns. You can see SRF, Deepak Nitrite, Navin Fluorine, etc. There are many examples. Okay, around that time, and if you listen to con calls of the chemical companies around that time, the China plus one talk was at its peak. Like we will go forever only now the sourcing won't happen from China, and like that. So multiple negatives were going on, and what happened was even some of the chemical companies who were basically trading in normal commodity chemicals started shifting, seeing huge shift in their margin. Deepak Nitrite, at that time had around before this chemical cycle started. Deepak Nitrite had around 10 to 12% margin. If you look in the screener before COVID, they had every year their margins were between 10 to 12%, and suddenly because of this negative change, because of COVID, all this supply change, their margins shot up to 24-25%. And the same thing can be seen with many other chemical companies. And what happened was, owing to this huge demand and huge margin pickup, many companies started doing big capex, which inflated their balance sheets. The balance sheet the interest cost started increasing, the depreciation started increasing. Okay, but the negative was key by demand would continue picking up because China is not out of the game. But sudden, what happened in 2023? Mr. Kenneth Andrade at that time had warned about it. Chemicals are seeing a peak cycle right now, but because if China makes a comeback, then it would all this capacity would sit idle, and the realizations would also go down. And that's exactly what happened in 2023. China made a comeback. Companies globally, the narrative of against China started, diminishing a little, and companies started showing because China was the lowest cost producer of many chemicals. So companies eventually started sourcing from China, and power costs in Europe and US were also increasing. So companies needed a lower cost supplier. So they started sourcing again from China, and what happened was chemical prices dropped suddenly. Okay, and what happened with the Indian chemical companies since then was they were left with lower realizations, higher capacity, lower realization, lower utilization, higher interest costs, and higher depreciation. So many chemical stocks since then, so the whole chemical sector since then has been completely derated. Okay, uh, because of low utilization and everything. And since then, chemical sector, if you look at in the markets, nobody like is interested in the chemical sector. But beneath that, within this 3-4 year period from 2023 to 2025 or 26, or let's say from 2021 to 26, some companies were really making a gradual business shift underlying, which is not visible on screen. Okay, they were transforming their business model from, let's say, a commodity heavy to, they were building capacities which could deliver 3-4 years down the line. Okay, and one such company is Jubilant Ingrevia, which we will look at now. So this is, if you look at the top half of the screen here, look at the fixed assets here. Okay, the fixed asset columns. This is 2021. They had around 1800 crores of fixed asset, and this has slowly increased since 2023. Exactly when the chemical cycle peaked, they started doing a new capex. Okay, as you can see here, right now the fixed assets are 2600, and plus there is 600 more in CWIP. So if you add the 600 more, their fixed asset base is right, would almost double now from what it was in 2023. Okay, and all this, see, if you look here below, if you look at the profit and loss statement, you will see how the interest and the depreciation cost has increased since 2023. Interest cost, which was around 20-30 crores, it suddenly spiked to 50-55 crores. And as I mentioned, the chemical companies saw peak margins around 2022, 2023. Yes, same thing happened with Jubilant as well. In 2021 and 22, you can see 17% margins. Those margins dropped to 11-12%. Okay, because all this new capex cost, was started accumulating into the PNL, and the depreciation, and so the gross margins dropped, and realizations dropped as well. Chemical prices came down, and global realization dropped as well. Crude oil prices also peaked around in 2022. So as crude oil prices came down, a lot of thing for so these margins which peaked at 17%, they came down to 10-12%. So, but within this fixed asset base that Jubilant has built over the last 3 years, this is all high margin, all all specialty chemicals and high margin capex which they have built. Okay, now these are the three business verticals of Jubilant Ingrevia. The first is specialty chemicals, second is nutrition and health solution, third is chemical intermediaries. Now, until 2023, most of the even 2022, most of the revenues, even today, most of the revenues are coming from this chemical intermediary business, which is basically a commodity business wherein they make acetic anhydride, ethyl acetate. Okay, I won't go into much detail around what is the usage of all these chemicals, but if you have heard the name of paracetamol and aspirin, all these chemical intermediaries are basically used as solvents to make all those pharma, and some other uses are also in making wood pulps and paints and all those things. But primary use is in pharma industry, wherein they go as solvents to make your paracetamols and aspirins and everything else. Okay. The specialty chemicals business naturally enjoys higher margins, and one of the main difference between specialty chemicals and normal chemicals is that the approval cycles for specialty chemicals very is very long, and it's a much more sticky business and a much more higher margin business compared to your normal commodities business. These are normal. The chemical intermediaries are your basically your bulk chemicals which anybody can make, and where the China dominance is very is very high. So but in specialty chemicals, what is you need a very good bit of R&D R&D experience. R&D costs are high. Okay, formulation matters, your quality, the consistency of the quality matters, and your customers do a audit for you, and technical know-how matters as well. So not everybody can enter here. Here the entry barriers are quite high in some of the specialty chemicals, and since the entry barriers are high, the customer stickiness is very high as well. The relationships are quite high as well. Okay, and Jubilant Ingrevia is number one in some of the in number one or number two in most of the chemicals they are making, like pyridine and picolines. They are number one globally. Okay, out of this pyridine and picoline, they may also make fine chemicals, and they do some CDMO for global customers. In the nutrition segment, they do B3 and B4. B3 is human grade nutrition solution, and B4 is vitamin B4, which goes into animal health and everything. So even in B3, they are now globally number two. Okay, and even in their basic commodity chemicals, they are amongst the lowest cost producers in the world. Okay, so, that's why one of the reasons now they have become number two in this acetic anhydride merchant market. So we will go to every each of these segments now one by one. The specialty segments, the specialty chemical segment, this contributes 44% of the revenue, and it has a high EBITDA margin of 23-25%. If you look at the overall margin profile of Jubilant, it's around 12 to 13% now, right now. But specialty chemicals division contributes 23%. On the overall, if you look at it a consolidated basis, whereas the revenue contribution of specialty chemicals is only 44%, the EBITDA contribution is around 75%, 70-75%. So what they do in chemical specialty chemicals is they take their pyridine and decadine chemistry, and they transform it into high value molecules like fine chemicals and other specialty intermediaries. They are globally the lowest cost producers of pyridine and beta picoline and all other value added products. The approval process of customers here are very long, usually 3 to 5 years. Okay, R&D timing line is also very long, and the product approvals also take very long. Plus, customers do the facility audit on their own. Every individual global customer does the audit facility on their own. So what this creates is once your facility is audited, once your products get approved, it creates a long time earning cycle and a long term sticky customer stickiness with the company. Okay, within this segment, the rising star of the specialty segment is their CDMO segment, wherein they make tailor-made solutions of tailor-made molecules for some global clients. Okay, and over the next 4 to 5 years, this segment will see the fastest growth. The CDMO and the agro CDMO segment. The applications of all these of the specialty chemicals, mainly it's into pharma, medicines, and API. The segment which they are scaling the most right now is agrochemicals, especially within the CDMO part. It is the herbicides and insecticides and other crop protection. And there are other some specialty materials like it goes into paints, coatings, some electronics materials, and even additives. The second segment is nutritional and health segment. This segment contributes 18% of the revenue and around 14 to 15% EBITDA margins, which is what the base level EBITDA margins of Jubilant, of the consolidated Jubilant Ingrevia, is around 12-13%. This segment is contributes to the average EBITDA margins. Okay, so 18% revenue and EBITDA contribution is similar, 18-20% only. So within this, they use beta picoline. Beta picoline is something which they make in the specialty chemical segment. Okay, beta picoline, which they make in the specialty chemical segment, is also used as a RM in their nutrition segment. So it is a sort of a backward integration. So they don't have to buy the RM for this nutrition segment from outside. Okay, they also have some little bit of a niche technology in this nutrition segment, which is called as air oxidization, which they use for manufacturing of vitamin B3. And hence, owing to this, that they manufacture the RM in-house itself, and this niche technology of air oxidation, they are the lowest cost producer of vitamin B3 globally. So within the nutrition segment, they have two categories. Okay, which is B3 and B4. B3 is human nutrition category, and B4 goes into animal health. Right now, most of the revenue is coming from B4 only, which is chlorine. The B4, the B3 segment, which is the human grade nutrition segment, the facility for it started only in last year, 2025. Okay, and it has very low utilization until now. The animal grade nutrition before, it delivers 13 to 15% margins, as we have seen here. The whole segment margins are 13 to 15% only. But the human grade vitamin, which is the vitamin B3, for which they are the lowest cost producers, that delivers 20 plus margins on an optimum utilization basis. Right now, it's not giving them 20% margins because the human grade B3 facility started only last year. The utilizations are very low right now because they are still onboarding customers. They are still getting some approvals from some customers. Customer audits are happening. So once this segment, the V3 segment scales up, the margin profile of this whole nutrition and health solution segments will also scale up. Okay, because 13-15% is coming from the animal segment itself. The human grade will add 20 plus percent. So on a blended basis, this segment will do around 16 to 18% margins going forward. So applications, the B4, which is choline, which goes into animal health, it goes mainly into the poultry, dairy, and fish feed, which rely on this B4 for their growth. The human grade, which is the B4 vitamin, it goes into fish washes and cream, which contain niacinamide. Okay, and it is also used in food and beverages, mainly energy drinks, breakfast cereals, and health supplements. The third segment, which used to be their primary segment, is the chemical intermediate segment. The revenue share of this segment is consistently going down from 2020 to 23 onwards. Okay, but okay, these are basically bulk chemicals which are used as building blocks in your everyday products. If you have to make paracetamol, aspirin, and other some other medicines. They are also used in paints, varnishes, wood coatings. Okay, acetaldehyde is used for acetic acid production, which goes into agrochemicals, etc. All these are low margin business, and all this is this is a very low margin segment for Jubilant, and it is also very cyclical. But what it does is it gives Jubilant very steady cash flows. Okay, and some of these chemicals are used as raw material in the specialty chemical segment. This is the main reason why they are continuing with this segment, and this is one of the main reasons why they don't want to give away this segment. Yeah, in this is the most important slide of the whole presentation. Some of you might be wondering, if the chemical intermediaries business only does 6 to 7% EBITDA margins, why are they even in this business? They are in this business because of this slide. If you pay attention here from bottom to up, here the life science chemicals, which is the chemical intermediaries business, 25% of the volume of this chemical intermediaries business is consumed in-house only. Okay, this is a strong mode of the company which allows them to be the lowest cost producers in some of the specialty chemicals that they make, because RM is sourced in-house only. And if you go further up, within the specialty chemicals, 45% of the pyridine and picolines volumes are used to make vitamin B3, which is the human grade nutrition, which they have started from last year. Okay, so 45% of the specialty chemicals raw material itself consumed in-house only. What this does is this creates a strong moat for Jubilant Ingrevia, wherein most of the raw materials is made in-house only, and they don't have to source it from outside. This makes, this makes their business more pricing competitive, and they don't have to rely on outside. The freight cost, they save on the freight cost as well. And the pricing pressure, the cyclicality of the pricing of all these raw materials, they don't have to deal with any of it. This is the most important slide in the whole presentation. So manufacturing facilities, company has 5 manufacturing facilities, and they have more than 50 plants over these 5 manufacturing facilities, which house around 2,300 people workforce. They have, along with it, they earlier had 2 R&D centers. They have now set up one more R&D center. Okay, where the 2 R&D centers earlier they had around 100 scientists. Now with the 3 R&D centers, they have close to 150 scientists. Out of the 50 plants, 7 plants are multi-purpose plants, wherein they can use them for creating any molecules. Right now, they have 50 plus products in R&D, and there are more than 100 plus opportunities which they are developing. So, user-wise and industry-wise diversification of the business, pharma constitutes to around 34% of the business. Agrochemicals constitute around 20%. Nutrition, the health and nutrition segment, is 19%, and rest of it around 25% is all the other segments. Okay, 56% of the business is in India, and 44% is exports. But exports are generally the CDMO exports are generally of a higher margin. Exports are mainly done in the specialty chemicals segment, and those normal naturally carry higher margin. So we will look at, right now we have seen what is Jubilant Ingrevia, what businesses they are operating, what is the margin profile of each of the businesses. Now we will look at what are the future margin drivers and what will lead to future growth in Jubilant Ingrevia. What is changing, what is the inflection point. So there are 2 main inflection points which are happening. One is happening in specialty chemicals. So we will look at the specialty chemicals part first. So this specialty chemical segment did around 1800 crores revenue in FY25, which the management is targeting to reach around close to double of the same, close to around 3400 by FY28, and by FY30 they have a vision of scaling this business to FY30. So if you see from 1800, if they go to 6,000 crores by FY30, that's like more than 3x jump, and this more than 3x jump is of high margin segment jump. Okay, all this all the future income from this segment will come at more than 25% margins. Right now, even within the specialty chemical segments, the fine chemicals and the CDMO account for around 50% of the revenues. Okay, this now within this itself, they are expecting the fine chemicals and CDMO business to scale to 66% of the specialty chemicals revenues, which would be a meaningful shift towards a higher value offerings. The CDMO business itself, they are targeting to go fivefold by FY30. FY30, which is right now doing around 400-500 crores, they are targeting around 2,500 to 3,000 crores of revenues from the CDMO itself. They have 10 confirmed molecules in their CDMO business, and those 10 confirmed molecules have a peak revenue potential of 1,200 crores incremental revenue, which will start delivering from Q4 itself. Out of these 10, one of their big ICO CDMO contracts worth to 2,800 crores is expected to start in Q4 itself. The Q4 results are tomorrow, and maybe we will get some idea whether how much of this of this new contract got commission and how was the revenue generated. It's a 5-year contract, around 500-600 crores per year, which will start in Q4 itself, and it will reach full run rate around from Q1 FY27. So the revenue growth in this segment is expected to accelerate in 2026-27 itself, because as I said previously, from they have done around 2,000 crores of capex from these last 3 years, from 2023 to 2026, and most of this capex is now in commercialization stage. So they don't need any more major capex right now. So it's at an inflection points where they will see revenue growth starting from FY27 itself. And they have a new CDMO, the CWIP, which we saw in the balance sheet. They have it is for the CDMO segment. That CDMO plant will start operations in 2027. So that's the last bit of, the final bit of capex which will get commissioned. The rest of it, all of it is done. Most of the costs are already incurred, and now the company is entering into a setting phase. The second future margin drivers would be the nutrition segment. Okay, until now, until FY25, most this segment was basically anchored around the animal nutrition segment, which delivers 13 to 15% margins. Okay, but company started a dedicated facility for the human grade nutritions in January 2025. And since it is the first year of operation, first full year of operation, the utilization level of this B3 plant is very low. And it is as they sign up more clients, as they get more approvals, this segment, the human grade B3 segment, is expected to ramp up over the next 2 years. Right now, utilization is only 20% in FY26, but by FY28 they are targeting a utilization of around close to 70%, which alone will add 200 crores of revenues to the revenues come to the company, and it will come at a higher EBITDA margins of 20%, because human grade has a higher margin than the animal grade segment. Okay, so this is another lever where their base margins of 12 to 13, which are 12 to 13%. This is another reason why their margins would expand going forward. By FY30, they have a target to achieve around 2,000 crores in revenues in this segment, which is both the human grade and animal grade segment. Okay, but most of the incremental revenues would come from the human grade segment itself. And since the human grade segment would scale up in revenues, management expects the segment margins, which are now 13 to 15%, it can go to up to 18% as well. One more thing why this segment can deliver higher margins, which is the B4 segment, the animal nutrition segment, is they have some supplies to Europe, and Europe has recently put an ADD on Chinese imports for chlorine chloride. Okay, chlorine chloride is one type of animal nutrition only, and since the realization in Europe for this chlorine chloride products are higher in Europe than in Indian markets, the company is expecting to generate some revenue from that market as well. Europe has around 60 KTPA capacity for chlorine chloride, and the company is targeting to capture around 6 to 8 KTPA out of that in the coming couple of years. So even in the animal segment, their realization are expected to go up by supplying to Europe. One bit of news which came out recently only, it came out in March only. Okay, that they have done an acquisition of a company named Remedix Pharma with 100% stake. So Remedix Pharma also operates in human nutrition segment, and they had around 25 crores. In FY25 they had around 25 crores of sales, and but they actually have capacities which can do sales of around 40-50 crores itself. And Jubilant got this acquisition at a very attractive valuation of around 0.6 times sales. They paid only 80 crores for company which had a top line of 25 crores in FY25. So this will again add to the top line to their human grade nutrition segment. Another change we have seen since 2022-23 to now in 2025-26 is they have completely changed the management of the management structure has been reset totally. Earlier within the specialty chemicals, they had only one co-CEO, okay, looking after the business. Now there are four people. There is a separate business head for fine chemicals. There is a separate business head for pyridine and picoline derivatives. There is a separate business head for CDMO. Okay, and there is a group head of specialty chemicals. Similarly, in nutrition segment as well, they have added more senior management. All the corporate, they have most of this manage and most of these people, if you look at their presentation, most of these people which they have onboarded here right now, they come with an industry experience of more than 15-20 years. So this itself shows the focus of the company, to grow these specialty chemicals and nutrition businesses. Over the last 2 to 3 years, they have also done some some cost saving initiatives. The power, as you can look in this slide, the power cost which around in FY23, which peaked around 17% of the revenues, they are now down to 10%. Similarly, some other expenses which peaked around 17% in FY24, they are now down to 15%. Okay, renewable, one of the reasons these costs have gone down is now renewable energy now constitutes 28% of their power consumption, and within the next year, the renewable energy share will go to 36%. So in their last AGM, the management did this Pinnacle FY30 vision. This is just a vision. This is not basically a guidance, but it is something which they are targeting internally. Okay, so right now their revenues are around 4,300 crores. By FY30, they are targeting peak revenues of around 12,000 crores, which is around 25% CAGR, and they are targeting an console level EBITDA of 17-18%. Initially, as I said, we can see 5 to 6% jump in margins. So current margins are 12 to 13%. By FY30, they are targeting around 17 to 18% margins, which would give them around 2,000 crores of close to 2,000 crores of EBITDA. And naturally, once the EBITDA margin scales, you will see an inflection in the ROE and ROC as well. So the specialty chemical segments, which is right now doing 1,800 crores of revenues in FY25, they are expecting that to reach 6,000 crores in revenues by FY30. That's the internal target. Chemical intermediary business, okay, it will go at a steady pace only. Okay, which is 6 to 7%. Okay, not much. The revenues which it's doing 1,700 crores and is expected to reach 2,500 crores by FY30. Similarly, for the nutrition and health segments, it's doing 750 crores right now, and that segment is also expected to scale 3x. Similarly, like specialty chemicals, and they are targeting it to reach around 2,000 crores of revenue with 18 to 20% EBITDA margin targets. So let's make three things clear here. The specialty chemicals and the nutrition chemical segment will see a threefold increase in revenues, but the commodity business, the chemical intermediary business, will only grow 1.5x. So right now, the nutrition and specialty chemicals, which contribute around 61 to 62% of the revenues, if they are able to achieve this, what they have stated in this slide, if they are able to achieve it, then let's say 80 to 85% of the revenues by FY30 will come from this specialty chemicals and nutrition segment itself, and more than 95% of the EBITDA will be contributed only by these two segments itself. So that and the specialty chemicals would have a margin of more than 25%. Health and nutrition segment will have around 18% margins. These are basic projections which I have made based on some of them are my assumptions, some of them are listening to phone calls from management. Okay. So right now, if I assume the margins don't expand meaningfully, let's say right now they are doing 13-14% only. Let's say margins don't expand, but revenues in 3-4 years go to 8,000, double in 3-4 years. Then they will have the around revenues of 8,500 crores with 14% EBITDA margins. So based on based on that, if you look at the current, then based on their, they will have an EBITDA of close to 1,200 crores. So that values the companies around 10 times EV EBITDA on their FY30 estimate. Okay, even if you take the 17x as the exit rate, we are still making around 13% CAGR in returns. But let's assume the base case where they do 1.5x of the current revenues. Naturally, operating leverage kicks in the more business you do, so margins naturally expand. Then I think 16% margins is a given, which I am expecting as the bare minimum which should happen by FY30. Okay, then that would give them around 1,600 crores of EBITDA. In that scenario, we make 25 to 26% annual CAGR returns. I am expecting an exit EBITDA of 20 times, which is their current valuation multiple. If you look at the screen, you will see the company is right now trading at 20 times EBITDA. Okay, just take the bull case now. What the management is, let's take the management's vision on face value. Let's assume they do 12,000 crores of revenue. In that case, since most of the revenues would come from the nutrition segment and the specialty chemicals, I assume they should be able to do 19-20% margins. Okay, within that case, they get an EBITDA of 2,300 crores, and if you look at it, then by that estimate, the company is currently only trading at 5.4 times the estimated EBITDA. If you take the bull case, if that happens, then you will get around 362% returns, which is close to 50% CAGR. And if you look at the chemical companies, the specialty chemicals companies in the market, be it AMI Organics, Navin Fluorine, SRF, they are all trading at more than 25 times EV EBITDA. So this transition needs to happen from a commodity heavy business to a specialty chemical business. Once this transition happens, and if the management is able to execute, the company naturally gets a higher multiple. There are no listed direct peers for Jubilant when you consider all these three businesses. But when you consider they are only their specialty chemical business, which is the pyridine and picoline and the diketene business, then Lakshmi Organics is the closest listed peer. Okay, and even Lakshmi Organics is currently right now trading at, even in the down cycle, it's trading at around 25 times EV EBITDA. So with Jubilant, we are getting only 20 times. So there is a reasonable amount of margin of safety. There are some other players in the CDMO space who are their peers are SRF, Aarti Industries, and PR Industries. This is in the agro CDMO space. So let's look at the risk. We have looked at the assumptions, what type of money we can make, but let's also look at the risk. Okay, the biggest risk is the execution and scale up risk. Okay, going from a commodity heavy business to a specialty chemicals business, the cycles are usually long. There can be delays in commissioning. There can be issues related to freight, because of crude oil and everything. Custom audits usually take time. Onboarding can take time. So this can this can push the story 1 or 2 years further back. The chemical intermediaries business, that's a very cyclical business, 6-7% margin business, and it is exposed to China dumping basically. So if that segment suffers some has some cyclicality, then we can see some slowdown there as well. Since the third risk is the demand slowdown in macroeconomic risk, since some part of the revenues are dealing with pharma and agrochemical industries, especially agrochemical industries has seen the worst cycle recently only. And if the agrochemical industry is very sensitive to weather patterns, So if something like that happens, then again it can lead to slowdown in revenues, low utilizations, and everything. The fourth major risk is the customer and product concentration risk, since they are scaling up the specialty chemical segment and especially the CDMO within that. The certain molecules, we have already seen one molecule which will contribute to 500 crores of revenues going forward. Unless the revenue becomes very dependent on those certain molecules and certain clients. Loss of any one big customer could have volatility in their earnings. But still, I have confidence that this company can do well. One of the reason is nearly they have done nearly 2,000 crores of capex, and they don't need any further. And this capex is now entering the monetization phase. So the if you look at the P&L and the balance sheet, the interest costs are at their peak. The we won't see any increase in interest cost. The depreciation is already there in the P&L as well. So whatever the increment, once they start this monetization, their top their EBITDA and the PAT growth should be much higher than their top line growth, because fixed costs are already absorbed in the P&L. Okay, for the CDMO business to scale fivefold from here, they would need some additional capacity. That would be managed from internal accruals as well, as well only, because they are generating around, even now they are generating around 450 to 500 crores of cash flows every year. And as the revenues increase, their cash flows will only improve. So even during this bad cycle of 4 to 5 years, from let's say 2020 to 2026, even in this bad phase, this company has consistently maintained more than 100% of the CFO to EBITDA conversion. That shows the strength of their business. That shows the strength of their efficiency of the operations and everything. The most of the incremental revenues from here on would be higher margins only. As we have seen in the previous slide, the chemical intermediaries business is expected to go only 1.5x, but the specialty chemicals and the health nutrition business will scale 3x in the next 4 years. Valuation exercise, we have seen it's trading at around 20 times EBITDA right now, and we know that specialty chemical companies all they trade at 25-30 times EBITDA. So we have that safety in the entry valuations as well. The last point which I want to make is, it's the most important point, which is the moat of the company is they are the lowest cost producers of some of the chemicals which they make. And one of the reasons they are the lowest cost producers is that they make their RM in-house only. This is the chart for Jubilant Ingrevia, and this is a weekly chart, and it looks poised for a breakout given the Q4 results are tomorrow. And if the results are good, then we should see a breakout above 800 levels, around 800 levels. If that happens, then we can see some sharp spikes. But even if that doesn't happen, despite a weak Q3, the chart is holding strong, which says the market is looking ahead to Q4 and FY27. And I believe in FY27 we should see, from FY27 itself we should see good results from this company. That's it, Punibhai. Hello.
Yeah, great, Ankit. So I think this company has been doing the transformation over the last 2, 3 years, 4 years, and possibly this could be the year of moving forward. That's what I also believe for this company. So Lakshmi Organic, we had the question, but I think you have answered that already, Ankit. So I think that's it from the question side.
Should I take it in the chat box?
Yeah, no. So there is no other question. I think you have answered some part of it already.
Okay.
Okay. Thanks, Ankit. We'll move to the next presenter now. You can stop sharing, Ankit. Gauri. Gauri, can you check if you can start sharing? Gauri, you can hear us?
Yes.
Okay, great.
Just a minute. I'm trying login through sharing my screen through mobile, so that's why it's taking time.
Okay.
Yes.
Gauri, we can move to the next presenter in the meantime. Then you can
So,
sort this.
just a minute, I'm just sharing screen through the laptop. I join out through the laptop.
Okay.
Okay, I'll join afterwards. I think seems some problem over here as well.
Sure.
Yeah.
Abhijit, you can go ahead actually, if you are able to listen.
Sure, Puniji. Thank you, everyone.
Yeah.
I hope my voice is loud and clear.
Yeah, it is.
All right, I'll start sharing my screen.
Yeah.
Let me know once you are able to see.
Yeah, we are able to see. You can go ahead.
All right. Thank you, Puniji, for this opportunity. I'm not a veteran in this stock market industry, but yes, I'm a biomedical engineer. Name is Abhijit Gangwal. But since last 7 years, I have got a very interest into stock market, and I started like everybody else starts. And right now I'm going through a learning phase. So this is my first presentation in ALD series. The stock that I'm going to present is International Conveyor Limited. I have given the title a long-term wealth creation idea, but looking at others' presentation, I'm doubting it now. Let's start. So this is kind of a chart. This is a weekly chart for the company. And if you see this weekly chart, we can assume that the stock is behaving under pressure since last 2 years. The high that stock hit was 150, and now it is trading currently at 77. On 21st May, like 2 days back, the company has shared some results. We'll just talk about it later. Okay, so starting from the introduction of the company, who is International Conveyor Limited. The company has got a 50 years of legacy. It was founded in 1973. The market cap is still very small, below 500 crore, but it is a niche player in the segment that it deals. Stock price, as I mentioned, is 77 currently. It has got two plants in India. One is in Kolkata and another is in Sambhajinagar, Maharashtra. It is the only company that is listed in a solid woven PVC belting, which are basically used in mining and material handling in mining industries and other. The company has got a very rich legacy of some of the very good certifications that are required to operate in other regions like US, Canada, China. Uh, it has got a 9001 2015 certifications, and it also has got subsidiaries outside India. The global presence includes International Belting Limited, India, International Conveyor America, Conveyor Holding Singapore, and International Conveyors Australia. So it specializes in safety critical underground mine belts, which are fireproof, anti-static, ozone resistance, and which and the requirement is very much in the mining industry majorly. Uh, as I said, it has got a long-standing relationship in mining and power industries globally. Talking about the products that this company deals, it has got PVC solid woven conveyor belts, which are fire retardant, anti-static. They are designed for coal mines and tough environments, and it has got international mining safety standard certifications as well. The application sectors can be coal mines, potash and salt mines, power plants, port and bulk logistics, and then all above ground industrial logistics where we use this. And recently they have also got some orders with waste management supplies. The client list of this company are some of the names. In India, it has got Tata Steel, Coal India, Shree Cement, JMS Minings, SMS Minings, and then abroad, if you see, they have got international clients like Rosebud Mines, Viacore, Belt Service Corporations, Belt Tech Industries. There are some of the images that depicts the product line that they have. The reason to choose this stock was it is kind of a value at a reasonable price that I feel. The stock price is currently 77. It has got a very good ROE and ROCE, and book value is very less. It's just trading. The book value currently is of 67 rupees. So there is a very good margin of safety, even if this, in a worst case scenario. The CAGR for last 10 years is 14%, and I'm hoping it to grow as most of the countries. This stock belongs to again a cyclical industry, minings and all, and as you all know, rare earth minerals, coal production, India, China, South Africa are still heavily dependent on coal for the power generation. We are parallelly working in renewable sectors also, but still coal plays a major role in energy sector. So for mining, this cycle, as it has erupted into a growth phase again, I feel this stock will perform well in coming years. Promoter still owns 70% of the equity. The Mr. A, Mr. W. Wal, he died actually last year. He passed away, and one of his son is again taking care of another company, but he is equally involved in this as a independent director. So, and public holding is still 28%, and FII's growth have been seen recently quarter over quarter. Currently, FIIs hold around 0.9% of the equity. Revenue are still on a very tight margin, but they are growing consistently. The PAT has also shown a very good growth. Last year, 2025, the PAT had a extra income from treasury incomes. But if we, apart from that, this year company has shown a very decent growth in operating income as well, and net profit also. Company is showing very good turnaround. As I said, why to choose this stock? There are a couple of reasons that I have listed. There are very few players in this segment, and it is kind of a shovel in a gold mine kind of theory. Proxy companies you can always bet on. This is a niche monopoly segment. It is working in, has got a high ROE and ROC. Currently trading at a very attractive valuations. It has also got a treasury safety net of almost 250 CRs that I mentioned in previous. They are also getting some earning from that. But as an investor, we should always focus on a operating growth, operating margin growth. And this year they have shown a very decent growth, and it has got a 50 plus years of legacy. That includes some of the very good certifications that are required to operate globally, and their exports is almost 25% of the total production. So once the global economy starts behaving well, I feel it will also get a very good orders. Uh, so, as I said, it is a cyclical industry. It has got tailwinds in the mining sectors now, and India is sustained coal-based power generation and mining activity. Infrastructure like port buildings, power house buildings, power plants, then logistics hubs. So the demand for conveyor belts will show some decent growth. Global export markets also have got a very strong requirements for these products, and industrialization in emerging markets is driving the demand for these conveyor belts. There are some risk associated with this stock. Revenue is very volatile since last 3 years, but last year it was very bad. This year they have performed well, and also the operating margins have increased in a very good way. It has got a exposure to coal sector, so coal mining, we are like since last few years coal mining, apart from coal mining we are also dealing with so many renewable energy sources and another energy options we are looking for. So it can impact the demand for these belts, but at the same time ports, logistics hubs are getting increased attention, so I feel this risk can be mitigated anyways. And apart from coal, they are also diversifying into salts, potash. So they have got a very good orders from Australia subsidiary too. Working capital days are rising continuously, which is creating cash flow pressure on the company. Lastly, the last year the working capitals were 276, and now it has almost doubled. So that is a factor which is very much important, and that's the major risk that I see currently. And another risk is, as promoter is heavily holding the equity, the liquidity is very low, so the float is very less to enter for large investors. So that is some risk associated with this stock. Currently, stock is trading at 7 to 80 of range. EPS is around 17 rupees. P ratio is varying from 5 to 8, but the book value is 66, so very good margin of safety. and price to book is also very good, 1.2. So I feel this stock, even if it doesn't behave well, there won't be much of a loss that I feel. And if this year the growth was shown, the stock has shown very decent growth. So if it continues to do the same, and trying to, like, they are also trying with other sectors as well to get a new entries. So if they get the same, and if they if they show that commitment fulfillment, this stock might give some 3x 4x returns that I see from here. And again, this is a concluding slide for me, pointing out some of the key factors that I already mentioned. And yes, this is that's all from me. Thank you.
Thanks, Abhijit. I think mining is anyway getting a lot of traction. So this is one of the companies which is into belt manufacturing for that. So possibly what you are saying would turn out to be the case in the coming 3 to 5 or 10 years.
Right,
Right.
Punichi.
Yeah. So let me check any questions from the. So one of the questions is sales are falling continuously. So in the past, so do you think it is going to change now, and with the triggers which you mentioned here?
On 21st May, the result were announced, and it has shown a very decent growth in sales revenue.
Okay.
So I feel it will do a good sales revenue, but yeah, the operating margin they are still trying to improve.
Okay. And how the raw material things will be impacted for this company? Is it going to impact in the long run or cyclical it is?
No, not at all. I feel the companies are based in India only. In actually, the reason I chose this stock was I am from Sambhajinagar, that is Aurangabad, Maharashtra, and Aurangabad, if you see, has got a very good industrial hub that have given very good companies like Veroc, Endurance, many more, which have given very even the Sterlite Technologies, which is running, like, given multi bagger returns in last 2 months, and then Garware Films. So I always try to, whenever I visit my hometown, I just try to see what is the new thing that is coming up. And recently, when I visited, I saw this company, and it got my attention, and then I started researching. And I'm last 6 months I have invested a very decent amount, and I feel it should turn around from here. And even if it don't, there is a margin of safety that we always have to take as a risk. So I'm not like, I don't worry about this stock. I think it should go well from here.
Okay. Okay. Sure. Just have a look at any further questions in the chat, and then if you feel you need have an answer, you can just answer it there in the chat further.
Sure, Puneetji. Thank
Thanks
you very
for
much
taking
for the
this up in
opportunity.
the, you're the new presenter. Thanks for taking it up this time. Kudos to you.
Thank you. Thank you.
Okay, we move toward the last presentation of the day. Gauri, can you try to share now?
Hello, am I audible?
Yes, you are.
Yeah.
Yes, we can see your screen.
Is it visible?
Yes.
So, hello everyone. I do this company as a Mukand Limited. So Mukund Limited it is basically the steel it is basically belong from the steel industry. So they are manufacturing the steel products which is related to like alloy steel, bars, billets, rods, and some industrial equipments as well. And this is the expertise which is completely over the steel and steel products. So this is the part of the Bajaj Group, which is involved in the automobiles, as we all know, automobiles, home appliances, iron and steel, insurance, finances, and the travels. So this is the key group companies which is related and which is a part of the Bajaj is nothing but the Bajaj Automobile, Electricals, Finance, Bajaj Finserves, and Bajaj Holding and Investments. Going forward to the promoter of this Mukund is nothing but the Neeraj Bajaj, which is the main managing director, and the other like Prem Kumar ji, Tasim Mehta, and Sankat Kumar. They are the independent director, and the full-time director for this is Neerav Bajaj. Strategic growth and the tailwinds we can observe over this, like completely depending upon the India's booming infrastructure, defense structure. They are currently expanding. Then the automotive sector of the growth. Afterwards, which is the factor which is related for the growth drivers is for they are currently looking through and going through the green steel. Then the currently they in the recent case which is going on for the land sales in the Thane area, so which is also got the sale, and due to that the debate got reduction in that field. So and the profitable surge we can go through the massive in the because of that the so many of the sales with the happen in the sales in the Thane area, so which can be so much profitability of the Mukund currently they are going forward. Financial tailwind strategic growth, which is depending upon the consolidated net profits, which is approximately 604 crores, and which is belong for the operational optimization. Second point is for the debate delivering, and which is related for the strategic land yielded approximately 800 crores, which is got borrowing cost and the core debate. Then joint ventures, which the company is having a joint venture, which is for the Japanese company, which is a Sumitomo, and the part of that is the Mukund Special Steel Limited, which is operates for the high capacity rolling mills and targeting automotive and alloy sectors. Strength, the company's strength, it depends upon the like processing of so many of a deep industrial castings, then steel productions, heavy machineries building. The second point is for the improving the financial efficiency, which is like ROC, and successfully they are growing for the profit and margins and increasing their book values. Third point, which is strong operational assets, like they are like sustainable in-house infrastructure allows for the third-party vendors and for the heavy machineries manufacturing. Weaknesses we can consider for the debate having so much burden, but currently they are working on it, and the significantly which is for the capital structures and limiting the financial flexibilities, which is increasing the interest cost. Second, I can consider for the revenue and profitability, which is for the steel and capital good players. For this, the growth and the revenue operating profit margin during this is like a downturns, as per we can consider for the global economy. Then institutional shareholding reduction for the third point we can consider for this occasionally reducing in the shareholdings. Currently they are having a approximately 74 percentage of the stocks which is holding by the promoters, and the other percentage which is in the retail market. Opportunity we can consider for this, they are like expanding for these Indian infrastructure as well as for the railways, and defense generates the robust demands for the heavy machineries for the steels components. And second point is for the assets monetization is depending for this, for the real estates, basically for the infrastructure in the metropolitan regions or the cities, we can which is like aggressively in the high demand. For the supply chains and diversification, it is for the expanding the exports in the global market, which is securing the border for the customer base for the domestic people. Threats we can consider for this is for the raw material prices. It completely depend upon the Indian market, which is the like the cost in the iron, core, nickel. That is a basic of the company's components, and as per that we can consider for the intense market competition. It is completely depending on the domestic pricing and the expert pressuring for this impact. Economic downturn we can consider for this is like for the capex, which is completely affecting for this heavy machinery and the casting divisions. Basic key clients for this is Maruti Suzuki, Hyundai, Toyota, then Nissan, Bajaj Auto, Hero Motocorp, Honda Motorcycles, and the Scooters India Limited. These are the key clients for this Mukund Limited. Top competitor for the steel industry for this is we can consider the Tata Steel and the JSW Steels. On the basically Jindal Steels, which is the highest competitor for the stainless steel segments. Then the Vardhaman Special Steels Limited, which is completely for these alloy steels and the automotive engineering industry. Sunflag Iron Steel Cooperative Limited, which is for these steels and the carbon steels and the rolled products, which is the higher industry. Then Usha Martin Limited is for the wire rope manufacturing sector. These are the key factors or the key competitor of this steel industry market. Then fundamental ratios as per the market capital, we can consider this is a 2014 crore. Then the enterprise value is to 3,000 or more than 3,000 crore. This stock P is 3.33%. ROC is up to 23.1% approximately. It's for higher growth. ROE is 48.9% and CAGRE is for 21.8%, and free cash flow passed from 3 years is up to 160 crores. Critical takeaways from this quarter we can consider for the massive profit jump is due to this land sales which is going on currently for this Mukund, which is up to closure for this is 555 crore land, and reshaping the bottom lines, which is approximately quarter profit is spiking due to that. Then operational revenue we can consider this is up to 33.3% for this quarter. Then which is depending upon up to 1,770 crore is as per the demanding in the steel market. Then delivering power of the debate, which is reduction in the plants as they are considering the high margins in the alloy and stainless steel capitals. For the quarter four financial highlights is revenue, which is a high increase in the 33.3%. Then EBITDA TDA is up to 500 45.4% as per the basic of the quarter. Then net profit, which is increased up to 554 crore from the past year, past quarter we can consider. Moving next to the financial highlights, which is completely different. Like we have discussed, is like optimizing all the expenses and revenue, net income, profit margins for this is currently, which is in a consolidated, not too much boom, but it is stabilized. Technical charts overall the past years, which is now it's is in the like currently, which is going consolidated, not too much the little bit of the bullish we can consider it, but which is growing in the market. Key factor or financial red flags we can consider for this is persisting pressure for the margins and core operating in the market, and the capital efficiency, which is depending on the business cycles which is running on, and the kind of the debate burden the company is holding currently. Then income quality, which is depending upon for this we can consider as per the like the part of Bajaj, which is also some financial helpfulness for this company. Key risk we can consider for this is like a profitability and the margins, which is completely depending on the losses of the core operating margins and kind of the negative territory, which is up to 1.38%, and the revenue growth, and which is completely depending on that. The high leverage and the debate is up to like 6.37 to 7.14. Financial risk is struggling for the debate obligations, and which is kind of the covering the ratios of the week and the highlightly financial stability. Analysis for the key business efficiency and the risk is for the low capital efficiency. For the ROC and ROE, it's a little bit of the poor. We can consider it, but the overall performance of the company is currently in a high. Working capital and the inefficiencies, which is completely depending upon this inventory and the turnover, which is approximately 2.14 times is higher, and which is managing the stocks and essential funds for the business cycles over there. And operational executions and the risk, which is for this global volatility and the raw materials, is completely depend on the margins from that only. Then market underperformance is for the benchmark and the indications the trade significantly, which is moving in the average, as I mentioned earlier, like it is consolidated, is moving in the average only, not going so high and not going so low. Overall, the basis from this we can consider the summary for this is Mukund is currently improving their function, improving the market. As per this is approximately holding the 2 crore market cap, which is elevated for the debate to equity is around 1.58 to 1.62, and the chart which is suggest, which is a slow steady turnaround story, which is not going too much high and low, which is maintaining their like holdings in the market and performing as per going in through the down and the infrastructure as per the Indian market flow. uh, we can consider this is a highly company maintaining and the newly found quarterly profitability, which is sustaining the as per the technical upgrades. Thank you so much for listening.
Yeah, thanks, Gauri. So this is something wouldn't be on the radar of many of the investors, kind of a dark horse for a lot of us.
Okay.
So thanks for
Okay,
sharing
glad to
this.
hear.
Yeah. So any questions to Gauri, you can put in the chat or you can ask directly here. Little bit, I think, number of participants, people to hear has gone down now in the afternoon.
Yeah, I understand.
Any- no problem. So thanks for sharing again. I will
Morning
share
person
the
also, that's why.
video for the people to have a look.
Okay.
So before we close, we are going towards the quiz session. So thanks, Gauri. You can stop sharing for the time being. It was a wonderful presentation.
Yeah, thank you.
Okay, so we are towards the close of the session, but quiz is coming up, 4 questions. I'm sharing my screen. So Belrise Industries holds a significant share in which segment of the Indian automotive industry? Yeah, a lot of people have the answers already. So we'll break here and put to the next question. So Belrise Industries acquired H1 India. What is the moat they gained through this? Interestingly, the people who are presenting, they're also answering. So we have the answers there itself. So yeah, so a lot of you got the right answer. So we'll break here and the next question is coming up. International conveyor belts operate in niche monopoly. What is its core product line? Okay, the last question of the day is here. Jubilant Ingrevia is the lowest cost producer. What is causing them to have the low cost? Okay, I think you have all the answers. So I will have a look on all the questions and answers for the day and share the winner's name for the day. I have shared the feedback form as well for the presenters. It's good if you can rate the presenters based on the sessions you have listened to, or you can go through the recording and then rate them actually. So thanks a lot for your time today. We'll catch up next weekend, Sunday again. And again, 10 more businesses would be lined up for our consumption. So thanks to all the presenters who have taken all the efforts to present their thesis to us. Thank you once again. We'll catch up next week.